learning outcomes. After watching this video, you will be able to 1. Understand the meaning of market efficiency.
Hello and welcome to this lecture on efficient markets and portfolio performance evaluation. So, the first idea we want to explore is the idea of market efficiency. What is efficiency? Efficiency here refers very specifically to informational efficiency. What is informational efficiency? It simply means how quickly does information get into the price of any asset. It doesn't have to be a stock, a bond, it could be any asset, right? So the idea is the more efficient a market is, the quicker prices react to new information. And this is a really important concept because there is a great controversy out there in academic finance. Especially you will see this disagreement between academics and practitioners as to whether the market is efficient or not. Before we get on with the business of efficiency, let me also remind you that efficiency does not mean that at all times price is equal to what one might call intrinsic value. All they are asking is, if there are any pricing errors, they should not be systematic. In other words, a market will not systematically underprice or overprice any asset, right? So with that introduction, let me talk a little bit about whether a market can be perfectly efficient. So of course, when you start thinking about efficiency, let's say in engineering, about an engine, right? It is usual to conceive of an engine which is 100% efficient. Now, does this 100% efficient engine actually exist in the real world? The answer is no. But then why do we need that benchmark? Precisely because we will benchmark every real world engine to this 100% theoretically efficient engine. Similarly, people started asking a long time ago, is it true that a market can or will be perfectly efficient, that is 100%? And the answer is not really. And here is an argument by Grossman and Stiglitz. Way back 1980, they said the following. They said, look, no market can be perfectly informationally efficient. And the reason is the story that they sketched out in their paper, which I'm going to tell you in a few points. Number one, there is tons of investors in the market. Broadly, we can classify them into two kinds. One is informed, one is uninformed. In other words, the informed investors trade based on whatever information they uncover regarding a certain security or asset. Why do uninformed investors trade? Not for entertainment, certainly. They trade for example, liquidity reasons. That is to say, they want to, for example, I'm putting my daughter through college, so I want to liquidate part of my portfolio. Now, that has nothing to do with any information I might have about a particular part of my portfolio. I simply want money, right? So at that point, I'm acting as an uninformed investor. Now, focus on the informed investors for a little bit. Now, these guys work really, really hard to find mispricings in the market. Obviously, if they find that something is priced lower than it should be, they would like to buy, and vice versa. Now, where do they get this information? Well, they acquire it, and then they process it, right? And acquiring information as well as processing information is inherently a costly process. Why? Because we need smart brains, and smart brains don't come cheap, right? So that is the basic idea, that information is costly to acquire as well as process. Now, these guys get this information, process it, form views about certain securities, and place trades. Now, the point of the matter is, the more the informed traders there are and the harder they work, the more difficult it is to find inefficiencies. So imagine there's a bunch of 500 rupee notes lying on the floor, right? Now, of course, this situation won't last very long because some of us smart people will quickly pick up the 500 rupee notes and walk away, right? Now, the fact is, the more number of people there are searching for 500 rupee notes, the fewer 500 rupee notes you are likely to find lying on the ground. That is the idea here. So the very act of trying to utilize information to trade drives prices closer to value. And that is really the idea of these informed traders making the market efficient. However, let's say they make the market so efficient that it is 100% efficient. That is, price equals value perfectly. What happens then? Then the informed traders basically see that there is no return to their acquisition and processing information because they have no advantage over anybody else in the market. So at that point what happens? Well, they move on to other places and they say, I'm going to look for inefficiencies there or here. But then the moment these guys walk out the door and go to some other market, what happens is, now this market itself paradoxically becomes again a little inefficient and then more inefficient, right? So now the point to note here is, what is going to happen now? Again, people are going to enter this market in the hope of making money. So this is a vicious cycle, right? It's a state of disequilibrium which can only be broken in one way, right? Mathematically and logically, right? And the way to break this cycle is to think of a market as being efficient only to the extent that the marginal trader recoups his or her cost, right? So that is really the idea of Grossman and Stiglitz. Now, of course, this is an old argument, but I want to really pick on a couple of implications of their argument. Number one, since there is lots and lots of investors who are looking for inefficiencies, and this we can see all around us, there's lots and lots of market participants. They're all there to make money. So you can be sure that there are many investors looking for these mispricings or inefficiencies, which means that the probability of finding easy money opportunities is probably not going to be there, which simply means that markets will be largely efficient to a large degree, is what we are saying. Number two, if there is a certain market where the cost of exploiting inefficiencies is higher, for example, information acquisition costs are higher, right? Or maybe smart MBA students are in short supply, right? In these cases, when cost of finding mispricings is actually going to go up, well, naturally, you're more likely to find inefficiencies in precisely those markets. In other words, what we are saying is not that nobody can make money. If you are better than me marginally at acquiring / processing information, you can make a little more money than I can. So if you are the marginal investor, you will make money to the extent that you recoup your costs. That's the idea here. Finally, the degree of inefficiency in any market, and when I say market, I don't mean geography, I mean any asset market, will depend upon the number of informed investors who are around, who are closely looking to exploit opportunities. So that's really the story of Grossman and Stiglitz.
Learning outcomes. After watching this video, you will be able to 1. List down the various versions of efficient market hypothesis. 2. Understand the issues in testing the efficient market hypothesis.
Now, efficient markets hypothesis is basically a thesis or a theory that has been formulated a long time ago, in the 1960s, I should say, right, in three forms, right? So that is, there are three flavors of this theory. So like coffee, this theory comes in three flavors: decaf, half calf, full calf, right? So weak form efficiency basically says, look, you cannot use a series of past stock prices to predict future stock prices or any asset price, but I'm going to take the example of stock. So if you take any stock, your favorite stock, right, and if you look at a chart of previous prices, right, let's say for the last 3 months, 3 years, 10 years, and so on, right, that whole pattern of prices that has been followed up to now simply cannot be used to predict stock prices tomorrow, right. What that simply means is technical analysis, that is the study of stock charts and trying to figure out future prices, is completely useless. Number two, the second form of this is semi-strong. This says not only past prices, but no publicly available information can be used to make extra profits, which is saying, basically, if I look at the annual report of a company which was just released yesterday, and I think I can analyze it very well, and I can make money off of my analysis, I would be wrong according to the semi-strong form of efficiency, because all publicly available information, as soon as it is disseminated, is going to get into the stock price, right? In other words, all those analysts who are working on Wall Street, right, who are doing what is known as fundamental analysis, that is to say, analyzing publicly listed companies in the hope of trying to find investment opportunities, are simply wasting their time. At least that's the implication of this form of the theory. The strongest form of efficiency, which is really, really tough to believe actually, is that no information, public or even private. Notice that the strength of efficiency is going up as we move from form 1 to form 2 to form 3. Right? In the most extreme form of this theory, the strong form, no information at all can be utilized to make extra profits. So for example, the CEO of a well-known publicly listed company, right, even if he were not prevented by law from trading in the stock of his company, could not make any extra profits over and above the average man on the street, simply because his information, which is in his mind, is already inside the stock price. It's a little tough to believe, I know, but that's the theory. Now, if this is the theory, how do we test it? See, naturally, especially students who are engineers or scientists, etc., whenever I posit a theory, will usually ask me the question, how do we test this, Ramana? How do we test this? Because in the sciences, we have certain laws which we posit, and we find ways and means of testing those theories. For example, if you say at a fixed temperature, the relationship between the pressure and volume of a gas is in a certain direction, and that's something known as Boyle's law in physics, right? How do we test that? Well, you naturally think of setting up a laboratory experiment where you hold the temperature constant and you vary the pressure on a certain gas or the volume and observe the effect on the other factor, right? That's very easy to do in a science kind of a setting. Now, in economics and finance, unfortunately, these natural experiments are terribly difficult to set up. So naturally, we have to depend on past data regarding financial markets to try and tease out whether the market is efficient or not. Now, there are several issues in testing the so-called efficient market hypothesis. It is not a trivial job. Issue number one is magnitude. How efficient is the market? Can we observe the magnitude? What do I mean by that? So let's say there is a mutual fund manager who can beat the market by 0.5% per year, right? Now that is really valuable to his clientele because he is making 0.5% more than everybody else in the market on a consistent basis. The question is, since 0.5% is very small compared to the variation in stock returns, let's say on an annual basis, can we really observe this 0.5%? Unlikely, because statistically, all your estimates of outperformance are going to be ridden with error, and this error is going to be directly proportional to the variability of the stock return itself. So obviously, it's very tough to tease out that 0.5% extra performance. Number two, there is something called a selection bias. In other words, if you go out and take a poll of people, that is investors, and try and see if they're making money, right? Now, if you really had a money machine at your home, that is, you had a winning formula, the question is, would you publicize that fact? Maybe we are observing only those people who cannot beat the market, and the people who are actually beating the market handsomely are hidden out of plain sight, right? Of course, some of them are not hidden in plain sight. We have the Warren Buffetts of the world who are consistently beating the market on a fairly hefty basis, and they are out there in plain sight. So that's the question. So that leads me to point number three. So suppose there are these fund managers who really beat the market consistently. Are they skilled or are they lucky? This is an age-old debate again. How do you separate skill from luck, right? So this famous story is often told by efficient market theorists that if you give, say, 32 monkeys coins, fair coins, and ask them to flip coins, and 16 of them on average, we know, will flip heads. Now we declare the guys who flipped heads the winners, and take them to round 2. In round 2, 16 monkeys will flip coins again, and so on until at the end of 5 rounds, what you're going to end up with is one monkey that flipped 5 coins, 5 heads rather, in a row. Right? The question is this monkey particularly skilled at flipping coins and making them come up heads, or did the monkey just get lucky? Now, the story is usually told with monkeys because if you tell the story about human beings, we have these biases. Maybe we can train a person to flip heads all the time, right? But the point is, you really cannot reasonably conceive of a way of teaching a monkey flipping heads, right? So that's the origin of that story. But the point really is, are people just lucky if they have this run of winning stock returns or fund performance, or are they just supremely skilled? This is a debate. Now, of course, if somebody has beaten the market over 50 years, let's say like on average, Warren Buffett has been doing very well for many, many decades, right? It is really tough to dismiss his performance as coming from something being pure luck, right? On the other hand, you have to ask yourself the question, everybody has been observing Mr. Buffett's performance over the past several decades. Several books have been written about his investment style, and famously, he himself has described his investment style in very simple language, year after year, month after month, for the past several decades. But the question arises, if I simply read everything Warren Buffett has said and done and follow the same strategies, can I make money? The answer is not really, because this is one special individual. If it were so easy to discover a Buffett money machine and all of us make money, well, life would be much simpler. Unfortunately, we live in a more complex world. The next issue in testing efficiency is, fine, somebody has indeed beaten the market. Then the natural response of a finance theorist like myself would be to say, well, I'm not surprised you made more money than the market because you took a greater risk than the risk of the market, right? And then you will ask me, well, how do you figure out whether my extra return is commensurate with the extra risk I'm taking? Well, immediately you need a model that really links risk and return, right? And those models are called asset pricing models, right? The CAPM, the capital asset pricing model, being one of the more famous examples. Now the question is, how do you come up with the right risk adjustments? We can always fight about the model. In other words, it could be that the market is really efficient. In other words, you really did not make extra compensating for the risk. But if I use the wrong model, it will show up that you had better or worse performance relative to the model. Or the model itself may be a perfect model describing the commensurate risk for the commensurate return. However, the market may be inefficient. How do we separate these two hypotheses? It's practically impossible. So the idea is there's lots of tests that have come up, and people have nevertheless tried to do this.
Learning outcomes. After watching this video, you will be able to 1. Define an anomaly. 2. List down various market anomalies.
So it is emergent at this point, clearly, after many years of research, that there are several what are known as anomalies. What are anomalies? Anomalies are those are exceptions to the norm. For example, there is the well-known size effect. What is the size effect? It simply says that portfolios of small cap stocks, that is smaller company stocks, earn abnormally higher returns than large company stocks. Even after, and this is important, even after you control for beta risk. Beta is the CAPM beta here I'm talking about, right? And the graph which we're showing you is basically going to exactly illustrate that the fact that small stocks beat large stocks even after accounting for what we traditionally call risk, which is beta, right? That's one anomaly. The second anomaly, which is very striking, is the value versus growth anomaly. Here the idea is very simple. Suppose we sort all stocks in the universe, right, When I say universe, all the stocks on a particular exchange, let's say. And we sort them by the so-called book to market ratio. That's simply the book value of equity on the balance sheet divided by the market value of the equity, which is basically the market price times the number of shares in the market, right? So you take the book value to the market value. Just think a bit about what this ratio means. If the book to market ratio is high, invert that, the market to book ratio is low, which is to say, for every dollar of book value, the market is placing a lower market value on your company, right? Typically for growth companies, where the book value is likely to be very small, take a high-tech company for example, the market value is likely to be several times higher than the book value, which is to say these growth stocks typically have very low book to market ratios, and value stocks typically have high book to market ratios. So somebody did this very simple experiment of sorting every year stocks into value category and growth category. Basically taking the high book to market stocks, calling them value, take the low book to market stocks, call them growth, and basically let's say we run a horse race between two portfolios of value and growth. We start each of them with $100 or rupees or any currency, right, and let them perform and observe their performance after the portfolio has been formed. And you keep doing this not for 1 year, but for, let us say in this figure, we are seeing 22 years of data on US value, US growth. And what do you see? You see that 100 rupees in or $100 in 1973 would have ended up at about $600 in growth, but more than triple that, about $2,200 in value. Now what does that tell you? It tells you that value outperforms growth handsomely. At this point, this is not evidence of inefficiency. This is simply saying that, look, historically value stocks have performed better than growth stocks. Now a natural response, as I said before, is to say, well, if value outperformed growth in terms of returns, it must be that value stocks are somehow riskier than growth stocks. Now, people have tried to measure whether value and growth stocks have different betas. The answer is no. In this diagram, for example, I'm showing you that, in fact, if you look at the volatility or the sigma or the standard deviation of returns of value versus growth, what you are going to see is that growth is almost certainly, almost always, the higher volatility portfolio compared to value. This is bizarre for a finance theorist. Basically, this is telling you that you pick a bunch of stocks which are lower risk simply based on the label high book to market, and you can earn more than the opposite strategy of picking growth stocks. Now that can be construed as a evidence or a piece of evidence against efficient markets. Now the other anomaly I want to talk about briefly is the idea called momentum. The basic idea of momentum here is, suppose at the beginning of this year, on January 1st, I sort all stocks based on their past 6-month returns. Easily done. We could easily do it on a computer very quickly. And let us say the top decile, that is the top 10% of these stocks, we start calling them winners. And the bottom 10%, we start calling them losers. Just labels. So winners are essentially those who have performed well in the recent past, and losers, those who have not performed well at all in the last 6 months. Suppose I say I'm going to form this portfolio of buying these winners and selling the losers, right? Now, if the market were efficient, what would we expect the result of this net portfolio over the next month, 3 months, 6 months and 1 year? The answer is 0, because all we have done is we have sorted stocks based on their past returns. And if markets are efficient, past returns should not help us to predict or make trading strategies which are going to inform us about future returns. But if you look at the graph, what you find is the winners continue to outperform over the next 6 months or so, and the losers continue to underperform over the next 6 months or so. In other words, the winner minus loser portfolio makes about 1%. And this is not trivial number because this is 1% per month. So 1% per month for free, essentially. So that's upwards of 12% if you include compounding, etc. Now, nothing in the nature of efficient markets seems to be able to explain this phenomenon. So I've talked about size, I've talked about book to market, I've talked about momentum, right? So all of these point to one direction, which is that the markets are probably not as efficient as we would like them to be, at least we meaning the academics would like them to be. But this also points to the fact that there is money making opportunities out there, and the smarter and more intelligent investors, as I said before, somebody who is able to acquire and more importantly process, because in today's world with technology, etc., acquiring information is not the key element. Information is everywhere. In fact, we have too much of it. But then processing this information in an intelligent way, if I can do it better than you, I stand a chance of making money. So essentially what we are claiming is people like Mr. Buffett really get the same information as you and I, except they are able to process it better, they are able to put it to better use, and they are able to invest smarter than people like you and me.
Learning outcomes. After watching this video, you will be able to 1. Understand why there is a need to measure performance. 2. Define Sharpe ratio. 3. List down the issues with Sharpe measure.
So, the next part of this lecture is all about performance measurement. Now, performance measurement, as opposed to the previous section, is relevant to everybody, not just students of finance, right? And I will connect efficient markets to performance measurement very quickly. But before we do that, let's understand what is performance measurement. Essentially what we are saying is there is a bunch of us who invest in notably equity markets or stock markets through vehicles called mutual funds. Now these mutual funds come in two flavors, active and passive. Now, active mutual funds are those mutual funds which believe that they can again process or acquire information smarter, they're smarter than everybody else, so they can earn more money than what the average market return is. Now, passive mutual funds are those that seek to mimic a certain index. So, for example, there are S&P index funds which have the sole purpose of mimicking the return on the S&P 500. Essentially, if the S&P 500 goes up 5%, this fund aims to go up 5% too. Now, where do these active and passive mutual funds come from? Where do these philosophies come from? They come directly from what we talked about just now, which is the market efficiency idea. If you believe, let us say, that markets are largely efficient or close to 100% efficient, then the idea is obviously getting information, processing it, hiring fund managers and so on is not going to buy you much by way of extra return. In which case you would say I would go for a passive mutual fund, which is to say I will be a passive indexer, I will just put my money into an S&P 500 fund and let the money ride according to the fortunes of the S&P 500. However, if I believe that a particular manager is really exceptional at beating the market, I would actually go and invest my money with an active mutual fund manager. So these ideas are closely connected to the efficiency of the market. Now, in terms of active management, there's about $10 trillion under active management in the US alone. In India, for example, that number is about $200 billion. Now, obviously, this active fund manager, if he believes that he can outperform the market and deliver you an extra market return, he or she is obviously going to charge you a fee. Now, these fees are typically obviously higher for active mutual fund managers compared to passive mutual fund managers. Now, let's assume an average fee of 0.4%. If you think about the $10 trillion number I just stated, you would see that investors spend upwards of about $40 billion, right? And this is $40 billion with a B on fees to these fund managers. Now, if we are in aggregate paying these guys a lot of money, now we need to actually go back and investigate and figure out, are these guys making money for me? Because unless they are making money for me, I will not be willing to part with the fee for the management of the fund. Now, there is a battery of measures, right, which is used to test whether a particular fund/fund manager has done better or worse than the market, right? So, these come from the theory that we have studied called mean variance theory. So, the first measure I am going to talk about is something called the Sharpe measure. Now, the Sharpe measure is very simply an average return on the fund. So, RP bar is simply the return on a particular fund. RF bar is the average risk-free rate over the same period. So, take the average return of the fund, subtract the average risk-free rate. That's how much you earned over the risk-free rate. Now, divide that by the standard deviation of the portfolio's return or the fund's return, right? And what do you get? You get something which is very clearly a reward to risk ratio. This particular reward to risk ratio is called a Sharpe ratio, a Sharpe measure to be more precise, right? Now, suppose we do this with a bunch of funds. Obviously, if there is a fund which has a Sharpe ratio of 5 and another fund which has a Sharpe ratio of 2, obviously the one with a Sharpe ratio of 5 is set to perform better because for the same risk it is giving you a higher reward. So, essentially it is a standardized reward to risk ratio. Now, in isolation, this number 5 or 3 or 2, what does it mean? Well, there are statistics that can test whether you are performing better than a particular benchmark. So, I could just as well take the Sharpe ratio of a particular index, let's say the S&P 500 index. In other words, take the average returns on the S&P, subtract the average risk-free rate divided by the standard deviation of the S&P, and then compare that to the Sharpe ratio of a fund. Then I am in a position to figure out, using the Sharpe measure, whether my particular fund or my particular portfolio has actually beaten the index or not. Now, the Sharpe measure, as you might notice, has two immediate problems. Number one, the numerator contains the average fund performance, what I call RP bar. What is that? It's simply an arithmetic average of about 60 months or 48 months or 12 months of the fund returns. So, arithmetic averages can be notoriously misleading. Think of a situation where you have $100 to begin with, you have a 50% gain in year 1, that takes you to 150, and a 50% loss in year 2. That means your 150 has gone down to 75 at the end of year 2, which means over the 2 years what has happened is your 100 has become 75, which is a net loss of 25%. But if you take the arithmetic average of the two returns over the 2 years, 50%, negative 50%, average the two, you get 0. So, basically arithmetic average is not a true or accurate measure of the overall return over this period. Now, after all, investors really care about overall returns, they don't really care about the arithmetic average, right? That's something a statistician would be interested in, not an investor. So, that's an issue with the numerator. With the denominator, we have a slightly tangled issue, which is that in the denominator we have the standard deviation. What is standard deviation? It's simply a measure of how spread out the distribution of returns is around the mean or average value. Now, obviously, you can see this most clearly in a normal distribution, where if you have a tight normal distribution around the expected value or average versus a more spread out distribution, typically we say the more spread out distribution has a higher variance or standard deviation. Now, notice that the variance or standard deviation, which we are calling volatility here, is really a measure of uncertainty. What we really want in the denominator is a measure of risk. Now, by using standard deviation in the denominator, what we are doing is we are essentially saying volatility equals uncertainty equals risk. Now, uncertainty statistically is indeed standard deviation, but it is not risk in the way usually investors understand it. What is risk to you? If you think for a moment, what you will find is risk is really the loss of losing principal. In fact, if I perform better than average, it would still be counted in the standard deviation calculation, but that upside volatility is really not something that I traditionally think of as risk in my portfolio. What I really think of risk, or what I fear most in a portfolio context, is the downside. That is the possibility that I might perform below average. So we need to fix that too. And several measures have been suggested to fix this, and we will discuss this soon.
Learning outcomes. After watching this video, you will be able to 1. Define various performance measures like M-square measure, trainer measure, Jensen's alpha and appraisal ratio. 2. Understand when each method is used.
But before we go there is a simple measure which is a variant of Sharpe ratio. The only difference between Sharpe ratio and M-square is that the M-square answer, after plugging into the formula etc., is going to basically end up giving me a percentage number. So it has a one-to-one correspondence. So if my M-square measure is positive, meaning my fund's M-square measure is positive, it means that my Sharpe ratio is higher than that of the benchmark, whatever the benchmark might be. So there are other measures, but the first two measures can be encapsulated in this graph very simply. You will see that you will be reminded of your old mean variance frontiers and mean standard deviation diagrams when you look at this sort of a measure. So essentially a Sharpe measure higher than that of the benchmark corresponds to a positive M-square measure and vice versa. Now there are other measures, and people will argue that what really belongs in the denominator is not sigma or volatility, but it is really systematic risk, which, as we all know, is represented in finance by the quantity beta. Now, the moment I put beta in the denominator, that's really saying that my reward to risk ratio is not reward to total risk, it's reward to systematic risk. Now, once I come to this ratio, remember that in the bottom I have a beta. The moment I have a beta, you have to ask the question, beta with respect to what? With respect to some benchmark. Right? And the choice of benchmark is clearly an issue. So if you leave a fund manager to calculate his so-called trainer measure, which is exactly this reward to systematic risk ratio, naturally they would choose the benchmark which gives them the lowest beta in the denominator, which in turn will give him the highest trainer measure. So in other words, this is open to a little bit of manipulation, if you will. If it's too strong a word for you, think about subjectivity of benchmark. That's really the problem here. Perhaps the most popular and often encountered fund outperformance or underperformance measure is Jensen's alpha. After Michael Jensen, who first came up with the measure, it's a very simple idea. The basic idea is run a regression, a standard linear regression of my portfolio or fund return on the left hand side and the benchmark on the right hand side. Now the intercept in that regression is essentially the alpha. The idea is, after controlling for the beta, that is the systematic risk on the right hand side, is there any systematic outperformance or underperformance? In other words, if alpha is say 0.5% per year, we can confidently say, after accounting for the beta of this particular fund, this fund outperforms the market by 0.5% per year, and that's frequently called a positive alpha, right? And of course, the reverse is true too. If alpha is negative 0.5%, it means that this manager over the period of observation has underperformed the index or the benchmark by 0.5% per year. Now, this is a very popular measure, and we can run this very easily in a simple linear regression. Even Excel will do. You don't need a fancy statistical package, right? The only issue, as I pointed out before, is what is the benchmark on the right hand side. This is something we need to think about, right? But alpha is very popular on Wall Street, and in fact, if you ask a fund manager what he's looking for, he's going to perhaps 9 out of 10 reply, I'm looking for positive alpha. Now there is yet another measure called the appraisal ratio. defined simply as the alpha, which is simply the alpha I just talked about, the Jensen's alpha, and divide that by omega. And what is omega? Omega is simply a measure of idiosyncratic risk of the particular fund, right? It turns out this appraisal ratio is very useful in ranking funds in the following context. So suppose a large portion of my portfolio is in a benchmark fund, that is in an index fund, and I am looking not to move entirely into active managed funds, but I am looking to pick amongst actively managed funds to add as a small part of my portfolio. It turns out the benefit I can get from potentially moving a little bit into an active fund, whereas large part of my portfolio is in a index fund, is given by the appraisal ratio. So essentially it's a ranking tool. So the point I'm trying to make is, when is each method used? Well, depends on your particular purpose. If your portfolio is your entire retirement fund, then obviously that's your entire money, your life savings, and clearly their total risk is the most relevant measure. With all its problems, Sharpe measure would be the best thing to use there, and we'll come up with variants of Sharpe ratio very soon. If you're looking for a small amount of investment in an actively managed fund while having a large part of your portfolio in an index fund, as I said before, then you would use something called an appraisal ratio. Now the trainer measure is obviously used when systematic risk is relevant, which means when the portfolio represents one of the many active portfolios that are being mixed with a passive benchmark. So each one has its utility depending on the context. Now in terms of portfolio manager compensation, which is what we started this lecture with, in other words, we tried to look at how much are we paying these fund managers. Now Jensen's alpha is used widely. So suppose I say the Jensen's alpha of a particular fund with respect to an appropriate benchmark, let us say, is 1% per year. The question you have to ask yourself is, what is the compensation I am willing to pay to this portfolio manager? Well, he would like to keep as much of the 1% with himself as fees. Naturally, you would like as much of the 1% as possible with you. Naturally, he has to be compensated for his efforts. So we are going to part with some fraction of the 1%. So in other words, the Jensen's alpha represents an upper bound on the amount I am willing to pay the fund manager as compensation. But the danger with alpha, or any of these measures for that matter, is that the implicit assumption here is that somehow past performance is going to continue in the future. Now, as I hinted at this before, right, is past performance an indicator of future performance? Most likely no, we never know. Unless you have a super consistent fund manager. There are a few, there have been a few through history, but in most cases, past performance is not necessarily an indicator of the future. In any case, it is wise to remember this as a warning in our personal investment portfolios. This is what I meant when I said this is a part of the lecture which is relevant to all of us. So whether you're a finance graduate or not, as long as you make money, and I hope you do, and you invest, these measures are relevant to the extent that you want to understand how much your manager is working for you, which in turn means how much your money is going to grow and how much are you going to end up with. So this is the basic idea in portfolio manager compensation.
Learning outcomes. After watching this video, you will be able to 1. Understand market timing.
Now the next thing I want to talk about here is market timing. So remember that there are two components to a fund manager's performance. In fact, if you go and ask an actively managed fund manager and ask him, how do you make money? Most likely he will come up with one or two. Method 1 or method 2 or both. Method 1 is, I'm smarter, so I'm going to pick securities better than the next guy. In other words, I will select stocks better than the next guy, and that's how I make my money. That's called security selection. On the other hand, there is an aspect of making money which is called market timing. In other words, suppose I say I am very good at timing the market. What does that mean? It means that I know that stock markets are going to underperform next year. I'm able to prognosticate. So what I will do is, before the beginning of the year, I'm going to move from stocks to bonds. And if I know that stock market is going to perform better, I'm going to move into stocks at that time. So this ability to move in and out of the market at the right time is not surprisingly called timing. But if you look at this figure, what you will see is, suppose you draw a graph of a managed portfolio or a fund manager return on the y-axis, the vertical axis, and the return on the market or some benchmark on the x-axis. You will notice that this manager has absolutely zero alpha. That's the two lines meeting at the origin. And you will see that when the market is expected to be high, he moves into a high beta portfolio, which makes a lot of sense because the high beta portfolio stands to gain much more when the market itself is doing well. And when the market is forced to do not so well, that is a low state, he moves into a low beta portfolio, thereby limiting his exposure to the market. However, what I will observe is points A and B. I don't observe the two lines as an analyst. And when I observe the the 2 points A and B and connect a line through them, I get the dashed line. And the dashed line concludes two wrong things. Number one, it tells me that because it has a negative intercept, the fund manager has a negative alpha. Wrong conclusion number one. Number two, since the slope of the dashed line is larger than either of the solid lines, you would also falsely accuse this person of having greater, at least systematic risk, compared to what he had in either state. Bottom line, if you look at measures like alpha, they do not measure timing ability sensibly. We need better ways to try and measure whether managers can time markets in any sensible way. And that's where we're going to go next.
Learning outcomes. After watching this video, you will be able to 1. Define some more performance measures such as Sortino ratio and tail ratio.
So this is a graphical representation of the Sharpe ratio and the M-square ratio. Now we will move on to figure out solutions to the problems I identified with the Sharpe ratio. The first problem is that arithmetic mean is used, which is not truly accurate. The second, of course, is that the volatility in the denominator is really upside as well as downside volatility. So now we are going to look at a couple of ratios, one called the Sortino ratio and the other called the symmetric downside Sharpe ratio. Now both of them have the advantage that they fix both of these problems I highlighted. In the numerator, we have the geometric mean. In the case of the Sortini ratio, what you subtract from the geometric mean is something called the minimum acceptable ratio. That could be 0, that could be the risk-free rate, whatever the analyst might wish to choose. And the SDR Sharpe ratio, almost as a rule, uses the risk-free rate. The other difference from the Sharpe ratio is that in the denominator, these two ratios use something called the downside deviation. If you look at the formula carefully, you will observe that the downside deviation only measures the deviation below the average return and ignores all the deviation or volatility above the arithmetic mean. Notice that this is the way most of us think about risk. For most of us, risk is loss of money, let's say below average return. Now the SDR Sharpe ratio has another small issue with it. It has a root 2 factor, square root of 2 factor in the denominator. That is for technical reasons. So what we need to notice at this point is these two ratios are better at capturing what we think of as the notion of risk a little bit than the Sharpe ratio. Now the final ratio I'm going to be talking about in this section is something called the tail ratio. Now this is a very simple ratio. It takes a percentile number p, let's say 90th percentile, and says what is the average of all returns which are above the 90th percentile during the period under consideration. So if you stack up all the returns, find out the 90th percentile point, obviously the returns above that, the 10% of returns above that will have a certain average. Now take that in the numerator and divide that by the average return in the bottom 10%. Since you've chosen 90% on the upside, choose 10% on the downside. So essentially what this is telling you is, I am going to give you a ratio of the best months, the best 10% months to the worst 10% months. And you want to see where the variation of this fund's returns are coming from. Obviously, the higher this ratio, the better the fund's performance. Now, standalone, this is not great, but it's very useful as an adjunct to other measures. Now, I'm going to run you through a quick example. I'm going to just show you a graph across 73 months of two funds, hypothetical funds, A and B. Notice the important thing that both of them start off at a hypothetical value of 1000 and both of them end up 73 months later at this hypothetical value of 2000, which is to say, for somebody who has an investment horizon of 73 months or more, both of these funds might look identical in the sense that they start from the same point and take you to the same point. But it is not where you have traveled from and where you have traveled to, it is also how bumpy the ride has been throughout. Right? In other words, we care about risk. Now just have a look at this graph and tell me what you think in your mind, or at least make up your mind as to what you think is the riskier fund, A or B. Now most of us would agree that A has a lot of big hills, ups and downs, right? And B seems to sort of coast along and then go up and then some and go up again, right? Now, in fact, if you work out the standard deviation of these two funds, it turns out that B has the higher standard deviation. Now notice that the arithmetic as well as geometric means of these two funds are going to be almost the same. The geometric mean for sure is going to be identical because you started at the same point and ended at the same point. It turns out the arithmetic mean is roughly the same also. But given that B has a higher standard deviation, if you use Sharpe ratio, you would conclude that A is the better performing fund than B. But then, if you look at downside deviation and proceed to calculate the Sortino ratio or the SDR Sharpe ratio or the symmetric downside Sharpe ratio, what you will find is that conclusion is reversed, because now you confirm in numbers what you saw for yourself in the picture, which is that most of the volatility of fund B is really on the upside rather than downside. And for fund A, volatility is upside as well as downside. So that's the real big takeaway here. And by the way, if you calculate the tail ratio here, you will also find that fund B does better than fund A on that count also. So what we conclude from this small example is that traditional measures such as Jensen's alpha are hopeless as detecting timing ability. So here we have a manager who's showing timing ability. Clearly he is switching the beta of his fund in response to anticipated market conditions. However, traditional alpha or beta measures are not capturing his ability.
Learning outcomes. After watching this video, you will be able to 1. Understand the measurement of timing.
And what we realize is that it takes a little bit of work. So let me run you through a couple of equations. So first of all, suppose there is a portfolio manager who observes a signal about the excess returns on the market next period. And this is important. So essentially you have some ability to forecast the market next period, call it MT or REMT, that is excess return on the market in time T, but you observe the signal at time T minus 1, that is the period before, except you don't observe the signal with zero error. In other words, there is some uncertainty still even after you observe the signal as to whether your forecast is correct or not. And that uncertainty is represented by the delta T minus 1. That's okay. Once you have a precise enough signal, What you can do as a market timer is, of course, you will adjust the beta of your portfolio in response to the signal. So if your signal tells you that the market is going to outperform the risk-free rate next period, obviously you would want to be in a high beta position. If your signal tells you that the market is going to underperform the risk-free rate next period, you would want to be in a low beta position. In other words, you want your beta to be a linear function of your signal. And that's what I've shown you here in the slide. And once you plug that into your standard market model, what you observe is that there is now a excess market return square term on the right hand side. In other words, not only do you have a beta term on the right hand side, which is your traditional beta of your fund to the market, you also have a beta P2 here, which is going to represent timing ability. So if you observe in this regression a high beta 2, let's say positive, then you know that you have a positive timing ability. In other words, in response to an anticipated performance of the market over and above the risk-free rate, you're able to adjust your beta in a positive fashion. So that's one way to test for timing ability. The other way to test for timing ability is a closed variant, where you take not the square of the excess return on the market on the right hand side, but you take the market return minus the risk-free rate times a dummy variable which represents whether the market outperformed the RF or not. So the easiest way to read this equation is consider what happened in months when RM was greater than RF. That is the stock market return amount which is greater than the risk-free rate. Then the D would take a value of 1. Then the coefficient on the right hand side can be clubbed into beta 1 plus beta 2. In months when the market underperformed the risk-free rate, what you would find is the D would turn off, that is go off to a value of 0, leaving you with a coefficient of beta 1 on the right hand side. In other words, the beta P2 can be interpreted as a coefficient of how much you increased your beta in those months where the market outperformed the risk-free rate. If that beta P2 shows up to be a positive number, then that is some evidence that this particular manager has managed to somehow time the market, that is to say adjust the beta of his portfolio in response to anticipated market movements. Of course, having run these tests across, the evidence is almost near unanimous that most fund managers out there fail to have any sort of timing ability.
Learning outcomes. After watching this video, you will be able to 1. Understand style analysis and how it is carried out.
Now we move on to something called style analysis, which is very interesting, introduced for the first time by Professor William Sharpe, who also, by the way, won the Nobel Prize for coming up with the capital asset pricing model. Now, the style analysis model is very popular in the practitioner world. The basic idea here is to say, now how much of the variation of my particular fund can be explained simply as a combination of a bunch of passive index investments. To be more formal, suppose I have a bunch of indices on the right hand side represented in this equation by F1 through Fn. So what I want to do is I want to fit an equation Rp equals B1 F1 plus B2 F2 all the way to Bn Fn plus one error term Ep. It looks like a regression equation, but this is not really a regression equation. The difference is, number one, here Sharpe wants to constrain the betas to all lie between 0 and 1, and he wants the sum of the B's to be constrained to 1. In other words, he's thinking of the B's really as portfolio weights. So the idea is, to the extent possible, can we figure out a set of weights which could have been employed by a passive investor to largely mimic the variation in returns of this fund. Of course, you're never going to do a perfect job of mimicking the fund using a combination of these indices on the right hand side, The idea is to find the best possible combination ex post, that is after the fact. So the way to do this is to essentially minimize the variance of that error term, right, and figure out the right combination of the B's that would have minimized the variance of the E. And the idea is there is an R-square type measure here, which basically says most of the variation on this active managed fund could have been essentially replicated by a combination, a certain combination of index funds on the right hand side. Then the active fund manager is not doing much. If there is a significant part of the variation which cannot be explained by a combination of passive investments on the right hand side, then we begin to give some credit to the active fund manager. Now, this style analysis is A, easy, B, interesting, and C, very, very useful. Now, it can be used in a variety of ways, and I'm going to show you an example very soon as to how it can be used. In particular, it can be used very easily to check if funds follow the philosophy they say they will follow. So, for example, today in the United States as well as in several countries, a lot of funds essentially align themselves along something called a style grid. On one axis, you have, say, growth and value as the polar opposites. On another axis, you have size, that is small to large, as the polar opposites. Obviously, you can have, let's say, 9 quadrants on that 3 by 3 and basically say, well, I am a large cap value fund, I am a small cap growth fund, etc. Now, it is all well for a fund to say that they follow a certain philosophy, but it is up to you, the investor, or up to you, the analyst, to actually figure out if the fund is actually following the particular style that they're saying that they will follow. Now, here what I've done is essentially I've taken a couple of US stock mutual funds. These are large mutual funds. One of them is 32 billion in size. The other is about half that size, about 16 billion, still very large. One is a Vanguard fund. One is a Fidelity Dividend Growth Fund. Now, the interesting thing is the Vanguard fund advertises itself. I plucked this off their website. They say they are a large growth fund. The Fidelity fund, on the other hand, says they're a large blend fund. Blend being they're a blend of growth and value. And Morningstar, which is a well-known mutual fund rating agency, happens to give the Vanguard fund a 5-star rating and the Fidelity fund a 3-star rating. Now, my quest is very simple. I want to look at the battery of measures we've all studied until now and see if we can employ some of those measures and come up with a measure that replicates what Morningstar is doing. In other words, are our measures doing what they're supposed to do? Do they lead to the same conclusions as the Morningstar ratings? So I have a bunch of data which is slightly dated now, but it will serve the purpose. So my data goes from January 94 all the way through November 2005, which is about 143 months of data. So I'm going to use all our performance measures, and if you sit down and collect the returns of these funds and calculate each of these measures that we've discussed, what you've seen in the table is that really, yes, there is some slight edge of the VP fund, which is the Vanguard fund, over the Fidelity fund, right, in terms of slight increase in Sharpe ratio, slight increase in, say, the 1-factor alpha, etc., but nothing really pops out at you from this table. In other words, it's practically impossible to conclude just from this set of numbers that somehow we have this superlative performance of the Vanguard fund as opposed to the mediocre performance of the Fidelity fund. So I try to use style analysis now, and since these are both equity funds, I use as my passive indices or styles, as Sharpe calls them, on the right hand side, I use 6 particular styles. So the first one is a large cap growth index, which is essentially within the S&P 500, all the high market to book stocks, market value to book value stocks. In the large cap value, I have essentially that half of the S&P 500, which is the low market to book, or conversely the high book to market stocks. Similarly, mid-cap growth, mid-cap value, small-cap growth, and small-cap value. Essentially, I have 6 indices on the right-hand side as regressors, if you will, in the Sharpe style analysis. Now, what I have on the right-hand side in the graphs is that I have derived the optimal Bs, if you will, the optimal weights that could have largely replicated the variance in fund returns for both funds. First, the Vanguard fund, and the Vanguard fund, it turns out, has exposure to large growth, to small growth, to mid-cap growth, and large value. And what did they say they were? They said they were a large cap value fund. They said they were a large growth fund. So with style analysis, what we look at with the Vanguard fund and the Fidelity fund is that the weighting of different passive benchmarks that could have potentially replicated the performance of these two funds is shown in these two graphs. Now with the Vanguard fund, what we see is it has exposures not just to large growth as it purports to be, but also to other things like large value, small growth, mid-cap growth, etc. However, with the Fidelity fund, which says it is a large blend fund, you will see that the largest exposures are to large value and large growth. In other words, if you pardon me the pun, the Fidelity fund shows greater fidelity to its investment objective rather than the Vanguard fund. The other thing we could do is to actually conduct a rolling style analysis. That is to say, we take X number of months of returns and roll the window across which you determine the style of the fund up to the very end of the data. And you see how a fund style has evolved across time. And what you see, of course, is that in the Vanguard case, the style has been changing a lot over time. More importantly, it has never really been an exposure only to large growth. It has been exposed to several other styles, if you will, over time. Whereas with the Fidelity blend fund, what you see is, although it had exposures to other kinds of styles in the beginning of the sample period, towards the latter part of the period, the exposure is almost exclusively large growth and large value, as it should be. Now we could potentially use this style exposure at every point, because we have a style exposure at every month beyond a certain month until the end of the period, as the appropriate benchmark for this particular fund, and try to benchmark the fund to its own style benchmark. In other words, we are now benchmarking both these funds not against the S&P or any other such index, but we are saying I have my own special weighted set of passive benchmarks that I am going to call the benchmark for VPMCX, and I have my again similar set of a style benchmark for FDGFX, and I am going to benchmark the fund's performance against its own style benchmark. And when you do that, some things start to pop out right there, right? And what you see is, if you look at the Vanguard fund against its style benchmark, for the first time, statistically significantly, there is a outperformance relative to its style benchmark. In fact, you can do this more formally and try to run a regression of each of these fund returns against the S&P, against the pharma and French 3 factors, which is the market factor, the small minus big factor, and the high minus low factor, as you know, and of course now the new addition, the last row of this table, which is the rolling style benchmark. And what you see is results are practically statistically insignificant in the S&P case and the pharma French 3 factor case. But when you look at the rolling style analysis, what you see is, of course, that the Vanguard fund has an outperformance of 1% per month as opposed to the Fidelity fund of 0.61% per month. And the performance is much more statistically significant with the Vanguard fund. It is, of course, also significant with the Fidelity fund, which earned it 3 stars, if you remember, with the Morningstar guys. But clearly, Vanguard emerges as the outperformer among the two. And now you see why Morningstar would actually give the former fund a 5-star rating and the second fund a 3-star rating. That is the clear use of style analysis, which I said is a very interesting analysis.
Learning outcomes. After watching this video, you will be able to 1. Understand performance attribution.
Now we move on to something called performance attribution. The idea here is to say, find there is a certain set of outperformance, that is in numbers, over and above some benchmark, whatever the benchmark the manager might choose to benchmark himself or herself against. The point now is to ask, where is this outperformance, or for that matter underperformance, coming from? At the most basic level, outperformance can come from two places. One, it can come from asset allocation, that is to say, picking where you want to allocate your money to, that is to say, stocks, bonds, cash, etc. Right? In the case of a mixed fund, you would choose to willingly allocate X% to stock, X% to bonds, and so on, and prefer to perhaps leave some portion in cash. Right? Now, the other way to make money, if you will, is to basically within each of these asset classes, that is within stocks, within bonds, etc., choosing the right securities. So within the stock component, have I outperformed the stock benchmark? So basically what you have is essentially a two-way grid, basically saying starting from the passive portfolio benchmark all the way to the active portfolio return, you can get there in two ways. One is by timing, that is by allocation, being in the right market at the right time. Maybe you want to be in the stock market at the right time when stock markets are expected to outperform bond markets and vice versa, right? The other way to make money along the horizontal axis here is by selection. That is to say, within each asset class, I will pick the right securities. Both are ways of potentially making money, right? Now, I've given you a small example here of a blended fund, an equity plus bond fund, and you will notice that the benchmark here is a 60-30-10 portfolio, which happened to have a performance last year according to the numbers in the third column of this table. And so the portfolio benchmark has an overall performance of 3.97%. Now, my portfolio manager did two things. One is he deviated from the weights in the benchmark. Whereas the benchmark specified 60, 30 and 10 to stock, bond and cash, he preferred to hold 77 and 23. For whatever reason, in his or her wisdom, they chose to hold 70% equities, only 7% in bonds, and chose to not invest 23%, that is, hold it in cash. Now, also, of course, cash is cash, so the performance of the benchmark cash is the same as active cash, it's cash, right? But with stock and bond, you will observe that his performance in the stock part and the bond part again differs from that each sector in the benchmark. So the question is, after all this is accounted for, we know that the managed portfolio outperformed by 1.37% or 137 basis points. The question is, how much of this 137 basis points is attributable, and hence the name attribution, is attributable to security selection, and how much is it attributable to asset allocation? Now, the point we are trying to make here is there is two ways to make money, as I said before. So the asset allocation part is right there in front of you, right? So here what we are saying is, here I am only going to take into account the fact that my manager, for whatever reason, chose to deviate from the weight specified in the bogey or benchmark portfolio. And of course, the differences in weight, so the deviations have to sum up to zero, because if you over allocated relative to the benchmark in one, you will necessarily have under allocated in some other component. Now take that and multiply that with the performance of the benchmark, and this is important to note. Multiply this each component's performance by the benchmark, and what you end up with is a weighted average number of 31 basis points. In other words, out of the total outperformance, 31 basis points is clearly attributable to simply the deviations of my asset allocation compared to the so-called benchmark asset allocation. Now, for the other part, right? So obviously the 106 basis points that left over after we have accounted for this particular asset allocation must be coming from selection. In other words, now I take the active weights of my manager and say the stock part of the benchmark performed 5.81%, whereas the stock part of my active fund manager actually performed by 7.81%. Why? Presumably he picked the better stocks compared to simply holding a passive portfolio of equities. Now that difference of 7.28 minus 5.81% is attributable to his security selection ability. And so also in bonds. Of course in cash there can be no security selection ability. As I said before, cash is cash. Now the net impact of this when you do the numbers is 106 basis points. So in other words, basically 106 basis points is coming from the skill of the manager in selecting securities. And the earlier part was really the skill of the manager in weighting, underweighting or overweighting relative to the benchmark. So that's really the way to, so we have studied performance measures and now we have also studied basically how to analyze where the money is coming from, outperformance or underperformance. In other words, where is the money being gained or where is the money being lost.
Learning outcomes. After watching this video, you will be able to 1. Understand the performance of mutual funds.
Now I want to present to you in the last part of this lecture, right, the idea of do mutual fund managers actually beat the market? And this ties in with what we discussed in the early part of this lecture, which is the efficient markets part. And if you remember there, we said one way of testing if the markets are efficient is to see if people have indeed managed to beat the market. And if the market is largely efficient, it should be the case that a large fraction of managers at least cannot simply beat the market hollow, right? So what somebody did, this is a typical study by Professor Burton Malkiel, and this is an oldish study, but further studies also confirm evidence like this. He basically took all mutual funds around at that time for a 20-year period and essentially stacked them in a histogram based on their alphas, their Jensen's alphas. And what do you see? You see that a majority of these alphas are stacked around zero, are concentrated around zero. Now that shouldn't come as a surprise. This should tie in with exactly the statement I made before that markets are largely indeed efficient. Now to be sure, I'm not saying that money cannot be made. If you look on the far right of this graph, there is somebody who is 2-3 standard deviations, close to 3 standard deviations above the mean. And of course, on the extreme left, there is people who did really, really badly and they're 3 standard deviations close to below the mean. So obviously you have really, really good performers and really, really bad performers. But the key takeaway here is a large fraction of them bunch up around zero. In other words, this is some sort of evidence that the market is indeed largely efficient to the extent that it's not so easy to make money. So now another representative piece of research, especially slightly more recent research, is this paper by Daniel Greenblatt, Titman and Wermers, which was published in 1997, and what they essentially do is they take a bunch of known risk factors on the right hand side, like the pharma and French risk factors, plus they add a momentum factor on the right hand side. And what they do is they essentially take virtually every fund in existence and essentially benchmark the returns of each of these funds against these factors. And what you see in the table are the alpha numbers. What you see in the parentheses are the t statistics. And what you see really is that except for a few numbers out there, none of them is statistically significant, which is to say the alpha on average for the universe of mutual fund managers is not really statistically significant. In other words, mutual funds in aggregate are not beating the market. Yes, in certain segments, during certain time periods, mutual funds are beating the market. Now again, this begs the old question, was this just skill or was this pure luck? Now, Other pieces of evidence from research suggest that there is manager persistence, not fund persistence. In other words, the question has been asked, if a fund does well today, this year, will it do well next year? Well, it turns out the right question to ask is not the way I asked it just now. You should ask the question as follows. If a fund manager outperforms this year, is it likely that he will outperform next year? In other words, the fund manager could have switched jobs. So the persistence is about the manager rather than the fund. The other thing they notice in their paper, Chevalier and Ellison, also try and examine the characteristics of managers which make them better mutual fund managers. They find that age matters, younger managers are better, managers with MBAs are better, so that's a big shout out to all B schools out there. And they also find that undergrad institution matters. Now, undergrad institution might simply be a proxy, and I'm speculating here, for something like the SAT score or the sort of type of personality that a person might have, etc. But certainly these are the findings, right? Now, after all of this having been said and done, if the average mutual fund manager doesn't beat the market, and if a large fraction of mutual fund managers don't beat the market, and tying back to our initial part of the lecture, if markets are largely efficient, and this having been proved through a battery of performance measures, then the final question that one has to ask is, Ramana, why should I invest in mutual funds? Well, there is very good reasons to invest in mutual funds, even if we know all of these facts that the average mutual fund manager doesn't add value in terms of beating the market. Number one, ready-made diversification. Remember the first lesson of finance theory. In fact, if there's one lesson of finance theory which one has to master at a personal investing level, it is that diversification is a good thing. In other words, never put all your eggs into one basket. Now, as an investor, if you are like me, you're a small investor. Now, diversification amongst a bunch of stocks, say 100 stocks, might just be impossible for me alone simply because I have a capital constraint. In other words, there is a limit to the amount of money I can invest amongst a broad array of stocks. Whereas with a mutual fund, with a very small amount as an entry amount, I can actually buy into this large pool of investment and buy ready-made diversification. And that's a great reason, number one, to invest in mutual funds. Number two, the opportunity cost of keeping up with markets. Remember, these guys are professional. Albeit the fact that most of them don't add value, this is their daytime job. Now, my daytime job is teaching. Now, even if I thought I had some expertise in investing, now I would have to give up my daytime job if I had to do a proper job of monitoring my portfolio on a day-to-day basis, on a month-to-month basis, etc. But the fact of the matter is I might simply enjoy what I am doing. For example, I like teaching, and hence I would not give up my job. I would rather delegate the management of my money, my retirement funds, to a professional money manager. Number three, transaction costs. Basic idea here is these mutual funds are large institutions, and in terms of brokerage and transaction costs, it is almost certain that they have a huge advantage in transaction costs compared to an investor like you and me, right? So that is another good reason why one might actually choose to invest in mutual funds. Of course, there's always that final reason called hope, which is basically the idea that maybe, just maybe, I will hit upon the next Fidelity Magellan fund, which of course in the 70s and 80s was a superstar mutual fund, and actually have a happy, cushy retirement, right? So all of these are good reasons. However, at this point, we've sort of reached the end of the lecture. Now you have to make up, as intelligent students of finance, your mind about what your philosophy is regarding markets. Now, if you are one of those who believe that markets are largely efficient and hence only a few people will beat the market, and most important, as an investor, it is unlikely that a priori, that is before the fact, I can identify the superstar. Now, if I could identify the superstar at the beginning of the year, no problem. We would all actually enter him or her with our money. The big problem is we can only identify superstars looking backward, not looking forward. This is sort of like what Steve Jobs said, right? You can always connect the dots looking backward, not necessarily forward. So now if you can't really identify these superstars going forward, what do you do? Well, if you're like me and if you believe that the market is largely efficient, then you index. In other words, you invest in an investment vehicle which simply seeks to mimic a well-known index. So for example, you might choose to mimic an S&P 500, or if you're in India, you might choose to mimic the Nifty, and there essentially you're betting on the market movement. So you're saying, I'm a long-term investor, I believe that in the long run, so-and-so index is going to perform well, so I'm going to pick a low-cost alternative, an index fund, or nowadays what is known as an exchange-traded fund, which has its sole objective to simply mimic the performance of this particular index, and stick all your money into that, and with lots of prayer and hope, we might just get there and have a happy retirement. So that's efficient markets and portfolio performance measurement. Thanks.
Learning outcomes. After completing this video, you should be able to calculate the holding period return of a security, explain risk using standard deviation, calculate the expected return and risk of a security. Expected returns and risk. In this video, we will define what expected return and risk are and the relation between the two. Let's look at how you would calculate the return on an investment in a stock. Say you pay $50 to buy one share in a stock today. After a year, the stock price is $55. During the 1 year you hold the stock, it pays you a dividend of $1. So what return have you earned from holding the stock for a year? There are two parts. One is the income from the dividend, which is $1, and the other is the change in price from $50 to $55. You have earned a profit of $6 on an initial investment of $50, which means your holding period return over the 1 year is 6 divided by 50, which is 12%. We can write a general formula for holding period returns as follows: P sub 1 minus P sub 0 plus D sub 1 divided by P0. In this example, your ability to calculate the holding period return depends on knowing how much dividend you will be paid while you hold the stock, as well as what the stock price will be after a year. However, we almost never know what these future numbers will be. So all we can do is to estimate what the return over the next 1 year will be. The return, hence, is a random variable that is characterized by its possible outcomes and the probabilities associated with each outcome. We can then estimate an expected return of an investment using the possible outcomes and their probabilities. This expected return is what we use as the discount rate when we calculate present and future values. Now let's turn to risk. Most people think of risk as being a bad thing. They relate it to the likelihood of losing money. Risk is actually the uncertainty of outcomes, both good as well as bad. In the context of investments, risk is the uncertainty of future returns. This is usually measured using either the variance or standard deviation of returns. Larger the variance or standard deviation, larger is the risk. Now let's see how expected return and risk are related. You have $100 and two investment choices to make. The first investment will give you $105 guaranteed after 1 year. Since there is no uncertainty or risk in this payoff, this is what is called a risk-free or riskless investment. The second investment will pay you either $150 after 1 year with a 60% probability, or $80 after 1 year with a 40% probability. This investment is risky as your future payoff is uncertain. The question is, which investment should you invest in? To answer this question, we need to compute the expected return and risk of the two investments. For the first investment, the expected return is 105 minus 100 divided by 100, which is 5%. There is no uncertainty in the investment, and hence its risk is 0. For the second investment, we have to compute the expected return for both possible payoffs. When the future return is $150, the expected return is 150 minus 100 divided by 100, which is 50%. When the future payoff is $80, the expected return is 80 minus 100 divided by 100, which is a negative 20%. With this investment, now there is a 60% chance of a 50% return and a 40% chance of a negative 20% return. So its expected return is 0.6 times 50% plus 0.4 times minus 20%, which equals 22%. Clearly, the second investment seems more attractive given its higher expected return. However, what is its risk? Its variance is 0.6 times 0.5 minus 0.22 the whole squared plus 0.4 times negative 0.2 minus 0.22 the whole squared, which equals 0.1176. The standard deviation is simply the square root of variance. The square root of 0.1176 is 34.29%. The second investment has a return that is 17% higher, but also has a risk that is 34.29% higher. As an investor, is the additional 17% return appropriate for the 34.29% risk? The answer is that it depends on two things. One, the investor's attitude towards risk, which is the domain of utility theory. Two, models that help compare the risk and return of different investment choices. These models are called asset pricing models. We will answer the question as to which investment is better after we discuss utility theory next time. Learning outcomes. After watching this video, you will be able to understand the concept of risk aversion, describe what indifference curves are, calculate the utility of an investment using the utility function. Utility theory. In this video, we will learn about utility theory, which will later help us answer the question from the last video. Is a 17% additional return appropriate for the 34.29% addition in risk? We start by making two assumptions. One, we like more return with less risk. That is, we are greedy. Two, we are all risk averse. But what does it mean to be risk averse? Let me illustrate the idea of risk aversion with an example. Consider a gamble where you flip a coin and are paid 15 if you get a head and 5 if you get a tail. Assuming that a head and tail are equally likely, each has a probability of 50%. So your expected payoff from this gamble is 0.5 times 15 plus 0.5 times 5, which is equal to 10. The question is, how much would you pay as an entry fee to play this gamble? If you are willing to pay 10, which is the same as the expected payoff, then you are risk neutral. You don't care about the risk of the gamble. If you are willing to pay less than the expected payoff of 10, say 8, then you are risk averse. Here you say that since the payoff is uncertain, you need some compensation for holding the risk. Hence you are willing to pay less than the expected payoff, the difference in your mind being your compensation for bearing the risk of the payoff. If you are willing to pay more than the expected payoff of 10, say 12, then you are a risk lover or risk seeker. Here, you're saying that even though the expected payoff is only 10, you like the uncertainty or the risk of the payoff and hence are willing to pay more for it. If you think about it, this kind of behavior is not very common. Going back to our assumptions, we assume that all investors are risk averse. In other words, they demand compensation for bearing risk. Before we answer the question on which of the two investments from the last video is more attractive, you should understand the idea of utility theory. Utility is the happiness a person gets from consuming goods and services. In the case of investments, utility is the amount of happiness an investor gets from an investment. What if you have two goods to choose from? How would we measure your happiness? Let's say that the two goods are beer and pizza. The number of beers is on the vertical axis and the number of pizzas is on the horizontal axis. You feel that you are as happy having 10 beers and no pizza as having 5 pizzas and no beer. Plot these 2 points and join them with a straight line. This line is referred to as the indifference curve. It shows what different combinations of beer and pizza give you the same level of happiness. That is, in terms of satisfaction, you are indifferent between all combinations of beer and pizza on this straight line. Returning to the world of investments, we can put expected return on the vertical axis and risk on the horizontal axis. We can then draw multiple indifference curves. As you move towards the top left of the graph, the utility increases. This is referred to as non-satiation. You can always find an indifference curve at a higher utility level by moving towards the top left of the graph. Further note that the indifference curve is not a straight line but a curve. This is because of risk aversion. At low levels of risk, investors are happy with small levels of additional returns, but at higher levels of risk, they demand larger levels of additional risk. We can thus say that more risk-averse investors will have steeper indifference curves than less risk-averse investors. Investor happiness or utility may be quantified by using utility functions. We will use what is called a quadratic utility function. U is equal to ER minus half times A times sigma squared, where ER is the expected return of the investment, sigma squared is the variance of its returns, and A is the coefficient of risk aversion. If A is equal to 0, the investor is risk neutral. In other words, does not want to be compensated for any risk. If A is positive greater than 0, the investor is risk averse, and if A is negative less than 0, the investor is a risk lover or risk seeker. You may verify that this quadratic utility function satisfies our earlier assumptions on non-satiation and risk aversion. Next time, we will use the quadratic utility function to help us answer which of the two investments we saw earlier is better. Learning outcomes. After watching this video, you will be able to use the quadratic utility function to identify the better of two investments, calculate the expected return and risk of a portfolio consisting of a risky and risk-free asset. Investment choices and portfolios. In this video, we first answered the question as to which of the two investments we saw earlier is the better investment choice, and then talk about calculating expected returns and risk of portfolios. Using the quadratic utility function, let's try to answer the question as to which investment is better. Remember, the first investment has an expected return of 5% and 0 risk, and the second has an expected return of 22% and a risk of 34.29%. The answer as to which investment is better depends on the coefficient of risk aversion. Let's say that the coefficient of risk aversion A equals 3. Then the utility from the first investment is its expected return 0.05 minus half times the coefficient of risk aversion 3 times its risk 0 squared, which is equal to a utility of 0.05. The utility from the second investment is its expected return of 0.22 minus half minus the same coefficient of risk aversion 3 times its risk, which is 0.3429 squared, which gives us a utility of 0.0436. Clearly, the first investment has a higher utility, and hence an investor with a coefficient of risk aversion of 3 would prefer the first investment. What if the investor were risk neutral? Then A equals 0, in which case the second investment has the higher utility of 0.22 versus a utility of 0.05 for the first. So a risk neutral investor would prefer the second investment. In reality, investment does not mean investing in only one or the other asset. We can always form portfolios of assets by investing some of our wealth in each asset. Let's start off by looking at some portfolio math. If we form a portfolio of 2 assets, how will we determine its expected return and risk? For now, let's assume that one investment is risky and the second one is riskless. The expected return of a portfolio with these 2 investments, denoted as ER sub P, is W times ER plus 1 minus W times R sub F, where ER is the expected return of the risky investment, R sub F is the return on the riskless investment, and W is the proportion of your money invested in the risky investment. Consequently, 1 minus W is the proportion of your money invested in the riskless asset. Note, the proportion of weights must always add to 1. The portfolio variance, denoted as sigma sub P squared, is W squared times sigma squared, where sigma squared is the variance of the risky investment's return. Consequently, the standard deviation of the portfolio, denoted as sigma sub P, is W times sigma. Recall our earlier investment choice. The first investment was riskless and had a return of 5%, which means R sub F is equal to 5%. For the risky investment, we had ER equals 22% and sigma equals 34.29%. But what is W? Let's say that we fix W to be 60%. That is, 60% of your wealth is put in the risky asset and the balance 40% in the riskless. The expected return of this 60-40 portfolio is 0.6 times 22% plus 0.4 times 5%, which equals 15.2%. The standard deviation of this portfolio is 0.6 times 34.29%, which equals 20.57%. Now, is this 60-40 portfolio better than putting all your money in one of the 2 investments? To answer that question, we need to look at the utility you derive from this 60-40 portfolio. Remember, earlier, when we set the coefficient of risk aversion to 3, the risky investment gave a utility of 0.0436 and the riskless one gave a utility of 0.05. The utility from this 60-40 portfolio is its expected return of 0.152 minus half times the coefficient of risk aversion of 3 times its variance, which is 0.2057 squared. This gives us a utility of 0.0885. Clearly, this 60-40 portfolio is far better than putting your money in only one of the 2 investments. But is this the highest utility we can achieve? Or will another portfolio with different weights give us an even higher utility? Next time, we will discuss as to how to go about identifying the one portfolio that maximizes your utility. Learning outcomes. After watching this video, you will be able to define the capital allocation line, that is CAL, describe what it means to have asset weight greater than 100% or less than 0%, calculate the Sharpe ratio. Capital allocation. In this video, we will see how to allocate your money across 2 investments to maximize your utility. Last time, we saw that a 60-40 portfolio of the risky and riskless assets yielded a utility of 0.0885. But is 0.0885 the highest utility you can achieve? Not necessarily. To identify the portfolio with the highest utility, we will first generate all feasible combinations of the two assets. From among these feasible combinations, we will select the one with the highest utility. Going back to the portfolio math for just a bit, remember that sigma sub p equals W times sigma. We can solve for W as sigma sub p divided by sigma. Also recollect that the expected return on the portfolio is given by ER sub p, which equals W times ER plus 1 minus W times R sub f. Rearranging, we get ER sub p equals R sub f plus W times ER minus R sub f. Substituting for W in this equation, we now have ER sub p equals R sub f plus ER minus R sub f over sigma times sigma sub p. We know that ER minus RF is 0.22 minus 0.05, which equals 0.17, and that sigma is 0.3429. So now we have ER sub p equals R sub f plus 0.17 over 0.3429 times sigma sub p. This is a straight line that represents all feasible combinations of the two investments. This line is called the capital allocation line, CAL, as it represents the feasible ways in which you can allocate your capital across the two investments. The slope of the CAL is ER minus R sub f over sigma, which is the risk-reward ratio. It is the expected excess return per unit of risk. It is also commonly known as the Sharpe ratio. We can see the different feasible combinations of the two investments along the CAL in this figure. First, we have the point where W is 0. That is, all your capital is in the riskless asset. Then as you move along the line, you can see points with different weights in the two investments until you reach the point where W equals 100. This is where all your wealth is in the risky asset and none of it is in the riskless asset. What about the points on the CAL beyond where W equals 100%? At these points, W is clearly greater than 100%. What does it mean to have a weight greater than 100%? If you have $100, then you're investing more than $100 in the risky asset. If we invest, say, $120 in the risky asset, then we have W equals 120%. But how is that possible? Remember that weights must add up to 100%. So if the weight in the risky asset is 120%, then the weight in the riskless asset must equal negative 20%. The negative sign means that you borrow at the riskless rate of return. But how much must you borrow? You have $100, but you want to invest $120 in the risky asset, which means that you must borrow the additional $20. Denoting a negative sign for borrowing, the weight in the riskless asset is negative $20 over your initial wealth of $100, which gives us a negative 20%. This is the exact weight in the riskless asset that we needed to make the weights add to 100%. Going back to our initial problem of trying to maximize utility, which of the feasible portfolios on the CAL maximizes the utility for an investor with a risk aversion coefficient of 3? With some math, we can show that the optimal allocation in the risky investment may be written as W star equals ER minus R sub F over A times sigma squared in the denominator. If we plug in the values we know, we have W star equals 0.22 minus 0.05 over 3 times 0.3429 squared, which works out to be 0.4819. As an investor with a coefficient of risk aversion of 3, you will maximize your utility by putting 48.19% of your money in the risky asset and the balance 51.81% in the riskless asset. You can calculate the utility from this portfolio to be 0.09096 using the quadratic utility function. To understand this in terms of indifference curves, see the figure. The picture shows that an indifference curve with a utility of 0.05 is not optimal. You can do better by moving towards the top left. Remember, non-satiation. But then an indifference curve of 0.12 does not include any feasible portfolios. So the optimal investment is a point where the CAL is a tangent to an indifference curve. In our example, that is the indifference curve with a utility of 0.09096. In the real world, we have a large number of risky assets in which we can invest. Next time, we will see how to extend this analysis to more number of risky assets.
Learning outcomes. After watching this video, you will be able to calculate the expected return and variance of portfolio of two risky assets, plot the investment opportunity set for various weights in the risky assets, understand how the investment opportunity set changes with the correlation between the two assets' returns.
Risky portfolios. In this video, we will see what our set of feasible investment choices are when we have a number of risky assets. Let's expand the available investment choices to n risky assets and one riskless or risk-free asset. How should you invest your money across these n+1 assets? Before we answer that question, let's look at the portfolio math for larger portfolios. For a portfolio with two risky assets, the expected return ER sub P is W1 times ER1 plus W2 times ER2, where W1 is the weight in the first risky asset and ER1 is its expected return. Similarly, W2 and ER2 are the weights and expected return of the second risky asset. Remember, weights must still add to 1, that is W1 plus W2 equals 1. The portfolio variance sigma sub P squared is W1 squared times sigma 1 squared plus W2 squared times sigma 2 squared plus 2 times W1 times W2 times sigma 1 2, where the sigmas are the standard deviations of the two risky assets and sigma 1 2 is the covariance between the returns of the two assets. This covariance further equals rho 1 2 times sigma 1 times sigma 2, where rho 1 2 is the correlation between the two assets' returns. Taking the square root of the expression for portfolio variance gives us the standard deviation of portfolio returns, sigma sub P. Remember that the correlation coefficient can take values only between -1 and +1. The math can be extended to a portfolio of n risky assets. The expected return of a portfolio ER sub P equals W1 times ER1 plus W2 times ER2, so on, plus the last term Wn times ERn, where again all the weights must add to 1. The variance of this portfolio, sigma sub P squared, equals W1 squared times sigma 1 squared plus W2 squared times sigma 2 squared plus so on until the last term Wn squared times sigma n squared plus 2 times W1 times W2 times sigma 1 2 plus 2 times W1 times W3 times sigma 1 3 plus so on, the last term being 2 times Wn1 times Wn times sigma n minus 1 and n. Let's consider a portfolio of two risky assets now. Asset X has an expected return of 10% and a standard deviation of returns of 7%. And asset Y has an expected return of 20% and a standard deviation of returns of 10%. The expected return of this portfolio, ER sub P, is equal to W times 0.1 plus 1 minus W times 0.2. And its variance, sigma sub P,
squared is W squared times 0.07 squared plus 1 minus W squared times 0.1 squared plus 2 times W times 1 minus W times rho times 0.07 times 0.1. Note that W is the weight in asset X and 1 minus W is the weight in asset Y. Plotting expected returns and standard deviation will depend on the values for W and rho. A given pair of risky assets will always have only one rho. So let's start off by setting rho equal to +1. Then for different values of W between 0 and 1, we can compute a portfolio expected return, its variance and its standard deviation, and then plot them on a graph that has expected returns on the vertical axis and standard deviation on the horizontal axis. We use values of 0, 0.2, 0.4, 0.6, 0.8 and 1 for W while generating the plots. In the figure that you see, this is represented by the straight black line, which is called the investment opportunity set. This represents all possible combinations of expected returns and risk given the two risky assets X and Y and a correlation of +1 between their returns. If the correlation coefficient is 0.5, we get the dark blue curve. If rho is 0, we get the light blue curve. At a value of -0.5 for rho, we get the green curve, and finally at a value of -1 for rho, we get the pink curve, which you can see bends all the way back to the vertical axis. There are a couple of interesting things to note about these graphs. One, when the correlation changes, only the portfolio variance changes. Portfolio expected returns for a given W does not change. This is expected as the formula for portfolio expected return does not include the correlation coefficient rho. Secondly, as the correlation decreases from +1 to a -1, the plot curves further to the left. That is, we have portfolios with lower risk for the same expected return as the correlation decreases. In fact, some of the plots curve so far back to the left that the standard deviations of a number of portfolios formed with X and Y are far lower than the individual standard deviations of assets X and Y. This is the idea of diversification, which we will discuss in greater detail next time.
Learning outcomes. After watching this video, you will be able to understand the difference between the mean variance frontier and the efficient frontier. Define the minimum variance portfolio, that is MVP.
Diversification and efficient frontier. In the last video, we saw what happens when we combine two risky assets into a portfolio. We saw specifically that for some combinations of X and Y, the standard deviation of the portfolio is lower than the individual standard deviations of X and Y. This is the idea of diversification. In this video, we will discuss the idea of diversification in a little more detail and introduce the concept of efficient frontier. Let's revisit the picture from last class. Look at the black line when the correlation is +1. In this case, the standard deviations of all combinations of X and Y are always greater than that of asset X. This shows that diversification is not possible when the asset's returns are perfectly positively correlated. Diversification is possible only when asset returns are less than perfectly positively correlated. That is, rho is less than +1. Next, look at the pink curve when the correlation between asset returns is a -1. There is one point where the curve touches the vertical axis. At this point, the risk is 0. This says that when there is perfect negative correlation between two assets' returns, one particular combination of the two risky assets is riskless. In other words, this combination completely diversifies away all risk. Let's extend the two risky asset case to three risky assets
by adding another risky asset, Z. The expected returns and standard deviation for X are still 10% and 7% respectively. The numbers for Y are 20% and 10% respectively. And those for Z are now 15% and 12% respectively. We are also given that the correlation between X and Y's returns is 0.1, that between X and Z is 0, and that between Y and Z is 0.9. First, let's plot the investment opportunity set for each pair of investments. The blue curve is for X and Y, the green curve is for Y and Z, and the pink one is for X and Z. With each pair of risky assets, the investment opportunity set is just a curve or a line. What if we look at investing in all three assets at the same time? Then the investment opportunity set is a whole area. In the picture, this is the entire area within the black curve. Each point within this area represents a possible combination of X, Y, and Z. The black curve is called the mean variance frontier and plots the optimal combinations of X, Y, and Z. What does optimal combination of X, Y, and Z mean? The mean variance frontier joins portfolios of X, Y, and Z that yield the least risk at each level of expected return. Another way of looking at optimal combinations is what is the maximum expected return at each level of risk. Looking at the optimal combinations this way, at each level of risk, the expected return on the top part of the mean variance frontier is always greater than the expected return on the bottom part of the mean variance frontier. In other words, the top part always dominates the bottom part. If we exclude the bottom part of the mean variance frontier, the top part is called the efficient frontier. It maximizes the expected return at each level of risk and minimizes risk at each level of expected return. In terms of risk-return combinations, no risk-return combination to the left of or above the efficient frontier is feasible. An important point to note is the portfolio called MVP. It stands for the Global Minimum Variance Portfolio. Using X, Y, and Z, this is the one portfolio that has the least variance or risk across all portfolios in the investment opportunity set. Given risky assets X, Y, and Z, no combination of these assets will help us achieve a lower risk. In our example of three risky assets, how do we determine the efficient frontier? We will talk about two-fund separation and how it may be used to draw the efficient frontier next time.
Learning outcomes. After watching this video, you will be able to explain the two-fund separation theorem, solve for optimal weights of a portfolio using Solver in Excel, find an efficient portfolio given two efficient portfolios.
Two-fund separation. In the last video, we defined the efficient frontier. In this video, we will use two-fund separation to help us draw the efficient frontier when we have three risky assets. So what is two-fund separation? It says that any efficient portfolio may be obtained by combining two efficient portfolios. To plot the efficient frontier, let's start by identifying two portfolios on the efficient frontier. Remember, the expected returns and standard deviation of X are 10% and 7% respectively. Those of Y are 20% and 10% respectively. And those of Z are 15% and 12% respectively. Correlation between X and Y is 0.1, that between Y and Z is 0.9, and that between X and Z is 0. Let's pick two expected returns, 16% and 22%. We want to identify portfolios of X, Y, and Z that have returns of 16% and 22% and have the least risk at these levels of expected returns. In other words, we want to minimize
sigma sub p squared, which equals wx squared times 0.07 squared plus wy squared times 0.1 squared plus wz squared times 0.12 squared plus 2 times wx wy times 0.1 times 0.07 times 0.1 plus 2 times wy wz times 0.9 times 0.1 times 0.12 plus 2 times wx wz times 0 times 0.07 times 0.12 subject to the portfolio expected returns ER sub p, which is wx times 0.1 plus wy times 0.2 plus wz times 0.15 being equal to 0.16 and wx plus wy plus wz being equal to 1. This is a difficult problem to solve by hand, but Solver in Excel makes it easy to solve for wx, wy and wz. Set up your Excel spreadsheet exactly as you see on the screen. Use the sum product function to calculate the portfolio expected return. Fill in the formula, the long one, for portfolio variance as you see on your screen. Then click on Solver in the Data tab on your Excel screen. Your objective is to minimize the portfolio variance. So set objective should be linked to cell B7. And you want to minimize that. You want to minimize the variance by changing the weights of X, Y, and Z. So by changing variable cells should show B2 colon B4. The two constraints are that the expected return should be 0.16 and the weights should add to 1. We'll add those constraints as you can see. Once everything is set up, you can have Excel solve for the weights. We find that wx is 0.54, wy is 0.74, and wz is negative 0.28. With these weights, the lowest possible variance of 0.004118 is achieved at an expected return of 16%. You can verify that the weights add to 1. The negative weight for z says that you need to sell z, whereas the positive weights on x and y say that you need to buy them. We can similarly find the efficient portfolio with an expected return of 22%. You can verify that the weights are 0.2625, 1.6625, and negative 0.925 for x, y, and z respectively. Every other portfolio on the efficient frontier can be determined as a combination of these two efficient portfolios. Let's say you want to identify the efficient portfolio with an expected return of 20%. We need ER sub p to be equal to 0.12, which is equal to W times 0.16 plus 1 minus W times 0.22. Solving this for W, we get W equals 1/3. So what are the weights of X, Y, and Z in the efficient portfolio with an expected return of 20%? Wx equals 1/3 times 0.54 plus 2/3 times 0.2625, which equals 0.355. Wy equals 1/3 times 0.74 plus 2/3 times 1.6625, which equals 1.355. Wz equals 1/3 times negative 0.28 plus 2/3 times negative 0.925, which equals negative 0.71. Given these weights, you can now calculate the variance of this efficient portfolio. You can verify that this is 0.0783. You can see where this lies on the efficient frontier. In this manner, you can identify an efficient portfolio at each level of expected return and then join them to draw the efficient frontier. All you need is just two efficient portfolios to start with. This is the idea behind two-fund separation. Next time, we will revisit the concept of diversification and see how much risk can actually be diversified away. Learning outcomes. After watching this video, you will be able to explain why we cannot diversify away all risk, explain the difference between idiosyncratic and systematic risk. Diversification revisited. We earlier saw that having risky assets that are not perfectly positively correlated helps us reduce or diversify risk. Does that mean that we can endlessly reduce risk by simply adding more risky assets to our portfolio? This is going to be the focus of this video. Continuing with our portfolio with 3 risky assets, we can move the efficient frontier to the left by adding more risky assets to our portfolio. Will the efficient frontier eventually touch the vertical axis as we keep adding additional risky assets to our portfolio? That is, can we completely diversify away our risk? In other words, can we make it zero? In general, the answer is no. We can prove this in a couple of steps. The variance of a portfolio with n assets is sigma squared sub p, which equals the summation of I equal to 1 to n, wi squared, sigma I squared, plus the summation of I equal to 1 to n and the summation of j equal to 1 to n, I not being equal to j, wi times wj times sigma ij, where wi is the weight of asset I in the portfolio, sigma I squared is the variance of its returns, and sigma ij is the covariance between asset I and asset j returns. Now let's assume that the weight of each asset in the portfolio is the same, which means that each wi is equal to 1 over n. Let's further assume that all assets have the same variance v and each pair of assets has the same covariance c. This simplifies the expression of the portfolio variance to n times 1 over n squared times v plus n times n minus 1 times 1 over n squared times c. This can further be reduced to v over n plus n minus 1 over n times c. As n goes to infinity, a really large number, the first term becomes 0 and the second one simply becomes c. This tells us 2 things about large, well-diversified portfolio of assets. 1, only covariances matter and not so much the variances. 2, if the covariance is not 0, all risk cannot be diversified away. That is, we cannot make risk 0 even if we add a large number of assets to our portfolio. This risk that cannot be diversified away is called systematic or non-diversifiable risk. The part that can be diversified away is called idiosyncratic or diversifiable risk. As you can see in the figure now, increasing the number of stocks in the portfolio reduces its variance. The blue curve represents the total variance, while the horizontal black line represents the systematic risk. The gap between the blue curve and the black line is the idiosyncratic or diversifiable risk. As you can see, the diversifiable risk drops pretty quickly as the number of stocks in the portfolio increases. But beyond 50 to 60 stocks, one cannot achieve any additional diversification. At this point, the idiosyncratic risk is close to 0. Diversification is akin to the old saying, don't put all your eggs in one basket. If you drop the basket, all the eggs break. Here, diversification says, don't put all your money in one asset. If that asset performs poorly, you will lose all your wealth. Spread your wealth across various assets. The less than perfect positive correlation between these assets will help reduce your risk. So far, we have looked at investment opportunity sets that involve only risky assets. What happens to the investment opportunity set if we introduce a risk-free asset? Learning outcomes.
After watching this video, you will be able to explain how to identify the mean variance efficient portfolio, calculate the Sharpe ratio for the mean variance efficient portfolio, calculate the weights of the risky assets in the mean variance efficient portfolio using Excel. Let's go back to our two risky assets, X and Y. X has an expected return of 10% and a standard deviation of returns of 7%. And Y has an expected return of 20% and a standard deviation of returns of 10%. The correlation coefficient of their expected returns is 0.10. Now we add a risk-free asset with a return of 5% to the mix. By definition, risk-free means no risk, and so its standard deviation of returns is 0. And its correlation coefficients with both the risky assets are 0. We have the original mean variance frontier for X and Y. That is the black curve that runs through X and Y. Where will the risk-free asset lie on this picture? It has 0 risk, and so it will lie on the vertical axis. Now, how do we include the risk-free asset in our portfolio? We could form a portfolio with X and the risk-free asset. All combinations of these two lie on the red capital allocation line. Can we do better than this in terms of risk and returns? The answer is yes. Why? Remember non-satiation. We can always get higher utility by moving towards the top left. So what gives us a higher utility? A portfolio of Y and the risk-free asset, the blue line, has a steeper capital allocation line, which means higher utility. Can we do even better than this? The answer is yes. Make the capital allocation line from the risk-free asset steeper until it is tangential to the mean variance frontier between X and Y. This is the gray line from the risk-free asset through the point MVE, which lies on the mean variance frontier. MVE stands for the mean variance efficient portfolio. Now, can we do even better than this? Remember, we want to keep moving towards the top left as part of being non-satiated. However, the answer now is no, as the capital allocation line would no longer pass through or touch any point on the mean variance frontier. Increasing the slope any further would simply lead us to risk-return combinations that are infeasible given X, Y, and the risk-free asset. The mean variance efficient portfolio is at the point of tangency of the capital allocation line from the risk-free asset to the mean variance frontier. It provides the maximum reward to risk ratio, which is also called the Sharpe ratio. Now, how do we calculate the weights of X and Y in the mean variance efficient portfolio? We want to identify a portfolio that maximizes the Sharpe ratio. We want to calculate a pair of weights that maximizes the difference between the expected return of the portfolio and the risk-free rate of return divided by the standard deviation of the portfolio's returns, such that the expected return of the portfolio equals W times the expected return of X plus 1 minus W times the expected return of Y. And the standard deviation of the portfolio's return is the square root of W squared times the variance of X's returns plus 1 minus W the whole squared times the variance of Y's returns plus 2 times W times 1 minus W times the covariance between X and Y's returns. W here is the weight of X in the portfolio and 1 minus W is the weight of Y in the portfolio. We can solve for the weights using Excel. Enter the expected return for X in cell C2, its standard deviation of returns in cell D2, the expected return for Y in cell C3, and its standard deviation of returns in cell D3. Also enter the correlation coefficient between the returns in cell E3
and the risk-free return in cell C4. Enter the formula for the MVE portfolio's expected return in cell C5 and the formula for its standard deviation in cell D5. Enter the formula for the Sharpe ratio in cell C6. Now open Solver in Excel. Set objective should be linked to cell C6 since we want to maximize the Sharpe ratio. Click on the button to the left of Max. Under By Changing Variable Cells, select cell B2 as we want to maximize the Sharpe ratio by changing the weight of X in the portfolio. Then click on Solve. You will be able to see that B2 now shows a value of 0.3607. To calculate the weight of Y in the portfolio, in cell B3, enter the formula equals 1 minus B2. Cell B3 will now display a value of 0.6393. So the weight of X in the MVE portfolio is 36.07% and that of Y is 63.93%. The Sharpe ratio of the MVE portfolio is 1.6%. That is, for every 1% in risk, the MVE portfolio gives an excess return of 1.60%. Next time, we will introduce a third risky asset Z and see how the investment opportunity set changes. Learning outcomes. After watching this video, you will be able to calculate the optimal weights of 3 risky assets in the mean variance efficient portfolio using Excel, discuss what it means to have a negative weight for a risky asset in a portfolio. Investment opportunity set with 3 risky assets and a risk-free asset. How do we interpret situations where the weight on a risky asset or the risk-free asset is negative? That is the focus of this video. As a first step, let's introduce a third risky asset, Z. Remember, the expected returns and standard deviation of X are 10% and 7% respectively, and those of Y are 20% and 10% respectively. Now asset Z has expected returns of 15% and standard deviation of 12%. The correlation between X and Y is 0.10, that between Y and Z is 0.90, and that between X and Z is 0. You can set up the Excel spreadsheet as you can see. Cell B5 contains the sum of the weights of the 3 risky assets in the MVE portfolio. The formula for the MVE portfolio's expected return is in cell C7 and its standard deviation is in cell D7. The Sharpe ratio for the MVE portfolio is in cell C8. You want to maximize the Sharpe ratio using Solver, subject to the cell B5 being equal to 1. That is, the weights must add to 1. Once you run Solver, you will see that the weights of X, Y, and Z in the MVE portfolio are 0.2274, 1.7793, and negative 1.0067 respectively. The Sharpe ratio of the MVE portfolio is 1.94. What does the Sharpe ratio of 1.94 mean? For every 1% of risk, the MVE portfolio gives an excess return of 1.94%. Given X, Y, and Z and a risk-free rate of return of 5%, the maximum Sharpe ratio you can achieve is 1.94. The MVE portfolio is represented by the red dot in the figure that you see. Its expected return is 22.76% and its standard deviation of returns is 9.16%. If you look at the weights, you can see that the weight of Z in the MVE portfolio is negative. What does it mean to have a negative weight? It says that you sell asset Z and invest the proceeds of that sale in assets X and Y. But what if you do not own asset Z? How do you sell it? In this case, you short sell asset Z.
Short selling means that you sell something that you do not own. You can achieve this by borrowing asset Z from another investor and selling it, along with an obligation to replace the borrowed asset at a future time. How do we now interpret the weights? For every $1,000 you have, you short sell $1,006.70 worth of asset Z. This gives you a total of $2,006.70 in cash. Out of this, use $227.40 to buy asset X, and the balance $1,779.30 to buy asset Y. The capital allocation line from the risk-free asset to the MVE portfolio and beyond is now the investment opportunity set. Without the risk-free rate, the investment opportunity set is simply the efficient frontier, which is a curve. Adding a risk-free asset changes the shape of the investment opportunity set and increases the range of feasible risk and return combinations. An investor can invest in any combination of the MVE portfolio and the risk-free asset. If you're at the point on the vertical axis, all your wealth is in the risk-free asset. If you're at the red dot, all your wealth is in the MVE portfolio. Any point between the risk-free asset and MVE portfolio denotes a fraction of your wealth invested in each. Points on the capital allocation line to the right of the MVE portfolio denote points where the weight in the MVE portfolio is greater than 1 and that in the risk-free asset is negative. We have discussed this in an earlier video. Remember, these are points where you borrow at the risk-free rate of return and invest your wealth plus what you've borrowed in the MVE portfolio. For example, let's say that the weight in the MVE portfolio is 1.20. The weight in the risk-free asset is a negative 0.20, and you have $100 in cash. The weights imply that you borrow $20 at the risk-free rate of return. You now have a total of $120 which you invest in the MVE portfolio. Next time, we will discuss how to make the optimal allocation between risky and risk-free assets. Learning outcomes. After watching this video, you will be able to determine how to optimally allocate your wealth across risky and risk-free assets, distinguish between the investing decision and the financing decision, the optimal allocation between risky and risk-free assets. Once we identify the mean variance efficient portfolio, how do you decide what fraction of your wealth goes into the MVE portfolio and what fraction into the risk-free asset? This is what we'll discuss this time. The optimal allocation between the MVE portfolio and risk-free asset depends on your coefficient of risk aversion. Earlier, we had solved for the optimal weight in a risky asset as W star equals expected return on the risky asset minus the risk-free rate of return over capital A times sigma squared in the denominator. Here, the MVE portfolio is the risky asset. Remember that its expected return is 22.76% and its standard deviation is 9.16%. If we assume that your coefficient of risk aversion is 15, that is capital A equals 15, then the optimal weight in the MVE portfolio is 0.2276 minus 0.05 divided by 15 times 0.0916 squared. This works out to be 141.25%. If you have $100,000, then you should borrow $41,250 at the risk-free rate of return and invest the total of $141,250 in the MVE portfolio. The $141,250 must be split between X, Y, and Z according to the proportions 0.2274, 1.7793, and a negative 1.0067 respectively. That is, you should invest $32,120.25 in X, $251,326.125 in Y, and short sell $142,196.375 of asset Z. All investors follow a two-step allocation process. One, identify the MVE portfolio, which is the same for every investor. This is the investment decision. Two, decide on the split between the risk-free asset and the MVE portfolio. This depends on the investor's coefficient of risk aversion and is the financing decision. This is the separation property because it consists of two independent tasks, namely the investing and financing decisions. Next time, we will start talking about asset pricing models that relate risk to return. Learning outcomes. After watching this video, you will be able to describe the market portfolio, define the capital market line, the market portfolio and the capital market line. We have largely ignored the relation between risk and return, other than saying that riskier investments would require higher expected returns. But we haven't talked about what the fair return for an asset should be given its risk. This is the ambitious goal of asset pricing models, the first of which is the capital asset pricing model, CAPM in short. The CAPM is the earliest asset pricing model derived back in 1962. It is a theoretical model derived mathematically from first principles and not motivated by data. It is based on the concept of equilibrium, which is an economic state where no one wants to do anything differently. In equilibrium, the risk premium per unit of risk is the same for all assets. However, the CAPM is not supported by data. Some claim that it is not even testable with data. Though it is a very popular asset pricing model among practitioners, its practical relevance is ambiguous. Here is a long list of assumptions that were made to mathematically derive the CAPM. Investors only care about the mean and variance of their portfolios. All assets are divisible. All investors plan for one holding period, which may be 1 day, 1 month, 1 year, etc. There are no transaction costs or taxes. There is perfect competition among all investors. All investors are rational mean variance optimizers. A risk-free asset is available. Markets are in equilibrium, that is, they are properly priced given their risk. Asset pricing models, like the CAPM, attempt to explain the variation in the returns of different assets. For example, why is Apple's return different from that of Alphabet Inc.'s, which in turn is different from that of Microsoft, even though all three companies are in similar lines of business? The CAPM argues that this is because of the assets' betas. Let's get to describing the CAPM now. Remember the 3 risky and 1 risk-free asset case we saw earlier? We are simply going to extend that framework to all assets in the market. This includes all stocks, all bonds, currencies, derivatives, commodities, human capital, etc. With this universe of risky assets and 1 risk-free asset, we will still have an efficient frontier, which maximizes expected return for a given level of risk and minimizes risk for a given level of return. Drawing a tangent from the risk-free asset to the efficient frontier identifies the mean variance efficient portfolio. In the CAPM world, which includes the universe of risky assets, this MVE portfolio is called the market portfolio. The capital allocation line between the risk-free asset and the market portfolio is called the capital market line, CML in short. what is the weight of each risky asset in the market portfolio? The weight is the ratio of the market value of each risky asset to the market value of all risky assets. For example, the market value, also called market capitalization, of Facebook is the current value of all its shares outstanding. Facebook has 2.29 billion shares outstanding, and each share is currently worth $107. So its market capitalization is 2.29 billion times 107, which is $245 billion. The weight of Facebook in the market portfolio will be 245 billion divided by the market value of all risky assets. Let's go back to our three risky assets. Remember, the weights of the three risky assets X, Y, and Z in the MVE portfolio are 0.2274, 1.7793, and a negative 1.0067 respectively. If we assume that these are the only three risky assets in the entire world, is this MVE portfolio the market portfolio? The answer is no. Why? Remember, the weight of each risky asset in the market portfolio is in proportion to its market capitalization. Larger its market capitalization, larger is its weight in the market portfolio. Here, the weight of Z in the MVE portfolio is, however, negative. This implies that Z has a negative market capitalization, which is not possible. So the MVE portfolio, even though correctly identified, cannot be a market portfolio. Next time, we will see what the mathematical form of the CAPM is.
Learning outcomes. After watching this video, you will be able to understand the basics of trading strategies based on text mining.
Welcome back. You have seen number of types of trading strategies ranging from earnings drift based strategies to momentum based strategies. Before wrapping up this course, I want to introduce you to another class of strategies. Let me clarify right at the outset, we won't be able to do full justice to this topic. This is a topic which requires a specialized course on its own because it's gaining prominence. However, it's very important for an algo trader to know this topic. So this is basically trading strategies based on text mining, based on the language. So far, what we have seen is trading strategies based on accounting numbers or stock prices, right? So here we are going beyond that. The current technology allows us to go beyond that and try to infer based on the language used in either in the media or in the annual reports. That's the idea. So there are standard dictionaries available that will they classify words as negative, positive, optimistic, into different categories. So we pick up those categories and read a paragraph, and we will be able to classify that paragraph as whether it's positive or negative or optimistic or pessimistic, and then using this classification, we can develop trading strategies. That's the broad idea. So look at the language used in a write-up, and using that language develop a trading strategy. So these are text mining based trading strategies. So I will be briefly introducing you some of the strategies based on this. My request is that this 10-15 minutes that I'm going to do, this is my submission here, is not going to be sufficient to actually practice these strategies. The idea is that you guys should know what these strategies are, and hopefully we'll do another specialization which is based on text mining, because this will require a very good understanding of coding as well. Let me introduce what the strategy is. So this is based on this famous paper by Tetlock. This paper is titled More Than Words, Quantifying Language to Measure Firms' Fundamentals. Look at the title. It says More Than Words, Quantifying Language to Measure Firms' Fundamentals. So this is a Journal of Finance paper. I know by now you guys are familiar with Journal of Finance, Review of Financial Studies, or Journal of Financial Economics. You looked at papers. You also looked at accounting papers. So this is a Journal of Finance paper written by Tetlock and others. Now the idea here is very simple. what he does is he looks at, no, there are three authors here. So they look at the language that is used by media reports about a company. So they look at media reports, say, of any company, say Microsoft. So they pick up the number of negative words, and then they calculate number of negative words by total words. So this proportion of negative words. Now this they do for every company available out there. So they pick up standard newspapers which write about markets. So these are different in different countries. So theirs is for the United States. You can use the newspapers related to market in your respective countries. But the idea remains the same. Suppose you are tracking a company, you have a report on the company, identify number of negative words used in the report, and as I've told you, how do you classify a word into negative or positives? There are standard dictionaries available. You will have a challenge if the newspaper is a non-English newspaper. I'm sure in every language it should be able to, one should be able to classify words into negative and positive. So the idea is you get that proportion and rank companies based on those proportion. Now firms that have high proportion of negative news, the claim is, the hypothesis in this paper is their earnings are likely to be disappointing. The upcoming earnings are likely to be disappointing. Now you may wonder, so what? If earnings are disappointing, there are analyst reports, there are other research reports. Will they not point out the forthcoming expected bad earnings? The point of this paper is the language used can give you information over and above what an analyst report or analyst forecast gives. So the second point they make is, not only is this negative news predictor of a bad performance, markets underreact to this. That means if by now you must be able to guess the strategy. Would you want to take 10 seconds and think where I'm headed? What will be my trading strategy? Some of you might have guessed it right. The idea here is, suppose there is negative news about a company, the earnings are going to be bad, and the market does not incorporate the negative information fully. The negative information these articles convey fully into the prices. That means you have an opportunity to trade and make money. So what should you do? You should short those companies. Suppose market already incorporates, going by the super strong form of efficient market hypothesis. If market incorporates all forms of information, then there is no strategy here. Suppose a company has a lot of negative news, but the stock price is already nosedived, then you going and shorting may not work for you. But the important thing that they find is market does not price the upcoming negative event fully, and that is where you have an opportunity. So if a trading strategy which involves shorting these kind of companies is likely to make profits. So what you have to do, and they three, I'll read out from the abstract, you know the abstract. The main thing about the paper are 3 points. Fraction of negative words in firm specific news stories forecast low firm earnings. Firm stock prices briefly underreact to information embedded in negative words. And the earnings and return predictability from negative words is largest for stories that focus on fundamentals. Now this is important. That shows there is something in the news report. So there may be negative stories on extraneous reasons about the company, right? It could be some PR issue or something which is not very core to the operations of the firm. When the negative news is about the fundamental operation of the firm, what they find is that the performance of this strategy is likely to be higher. That means if you find a firm which has lot of negative press and that negative press coverage, and that coverage is about fundamentals of the firm, then if you go and short that company stock, you are likely to make a lot of money. So as I've said, this is not, you cannot manually do it. It's going to be very difficult. You cannot pick up newspaper every day and read every article about every company, calculate what is the proportion of negative news and come out with this proportion. That's not going to work. That's going to be very, very difficult. So you need a text mining software. If you're familiar with Python, there are online courses available on Python. You can pick up that. You should be able to do this on your own. So we will have a course on text mining. There are a number of strategies. In fact, TechClock has another paper where he looks at management discussion and analysis. Those of you who have taken, already undergone our previous courses, we spoke about annual reports. In annual report, you have a section called management discussion and analysis. This is standard in almost all countries. Here, basically, management puts out its views about the company. Now, what Tetlock does is another paper which is also published. Is he looks at looks at this news. It's not the news. It is the discussion in management, discussion and analysis, and categorizes it into optimistic and pessimistic. What he finds that is when the discussion is optimistic and you go long on the stock, you make money. And when it is pessimistic and you go short on the stock, there also you make money. That means the message conveyed in the language of management discussion and analysis is not incorporated in the price. This is over and above price earnings announcement drift. That's another strategy. So there are, this is an upcoming area of research. Lot of papers based on text analysis are coming. So I suggest that you start looking at these papers. It may not be possible to implement right now, but as an algorithmic trader using academic knowledge, academic research, you should be aware that such a class of strategies exist. So we will do more of this hopefully in another specialization. So I strongly urge you to read these papers. कितना हुआ?
Learning outcomes. After watching this video, you will be able to understand the importance of benchmarking.
Welcome back. In this session, we are going to talk about benchmarking. Now, benchmarking is a prerequisite before you start a fund. Even if you are investing your own money, even if you are investing money of your friends and family, it's absolutely necessary that you determine a benchmark. Otherwise, there is no way you can measure your performance. A minus 5% on its own doesn't tell whether you are done, good or bad. Imagine in the year 2008, if you have done minus 5%, you would have been one of the top performing funds or investors, in that year. Whereas in the subsequent year, when the markets rallied, even if you had earned say 20% or 15%, you may not be near top. You may be at the bottom or in the middle. So it's very important that beforehand you determine a benchmark. The importance goes up several notches higher if you are managing somebody else's money. Remember this, typical investor psychology which has been documented over and over again in different parts of the world. When the market goes up, generally people don't care about how you have done with respect to benchmark. Nobody, if you have done 40% return, if you have made 40%, even if the index has given 50%, investors will be fine with you, because at the end of the day they have made 40%. The importance of benchmark is higher when the market goes down. Suppose you have made minus 20, and even if the benchmark is down minus 40, unless you really go and communicate this to investors, they will think that you have done very badly. You may be thinking that in the market has gone up minus 40, I am down only minus 20, so I have done better. But generally, retail investors consider this as a bad performance. They don't care about the benchmark. So it's very important you communicate this to your investors that your performance has to be evaluated with respect to a benchmark. Now, what kind of an index you should choose as benchmark? Can you just choose a broad umbrella index like a Dow Jones or S&P 500? The answer is no. It depends on what your strategy is. What is the composition of stocks that you have? Suppose, let's take the growth strategy that we discussed. Do you remember the growth strategy that we spoke about? Yes, the G-score strategy. Now here, by definition we will be picking stocks which are likely to grow. And if you see the components of that strategy, we are looking at research and development, investments made in research and development, investments, capital expenditure, firms which are making all these are in growth industries. Now, if you compare these stocks to a broad index which comprises of all kinds of stocks, then you will not be making an apples to apples comparison. Things may be fine when the market goes up. In fact, these growth stocks tend to be high beta stocks. So when the market goes up, they may outperform the market, but this will haunt you when the market goes down. Suppose you for a G-score long only strategy. Remember, you chose a long only strategy and used G-score, and you determined the broad market index as your benchmark, and the market index falls by 10%. Now, for no fault of yours, even if you have done very well, the G-score stock, if you are long only, may fall 13%. In fact, if you consider the beta of those stocks, that may be 2. So ideally they should have fallen 20%, but your strategy has fallen only 13%. You have actually done well. But after the fact, if you go and explain it to an investor, nobody will buy your argument. You cannot go back and say, having determined a broad index as your benchmark, you cannot go back to the investor and say, I have invested in growth stocks, these are high beta, that should have gone down 20%, but actually it's gone down only 13%, we outperformed by 7%. No one will buy this argument. It's important therefore that you specify a benchmark ex ante. What do you mean by ex ante? Before the fact, not after the fact. So for a growth oriented strategy, right benchmark will be an index comprising of growth stocks. Identify in your respective market an index which comprises of growth stocks and make it a benchmark for a growth strategy. Similarly, if you are trading on a value strategy, what is wrong with having a broad index as a benchmark? These value stocks are, as we have discussed, again, when some of the value stocks, if you are following Petrosky, they are small stocks and they can lose a lot of money when the market falls. Again, if you compare it with the well-established, mature, large firms, when the market falls, you may not be able to explain this to investors why you are underperforming a broad index. There also you should select an appropriate value type index as a benchmark. So if you are long only, the problem is not that difficult, it's straightforward. Now what do you do when you are long short? The most strategies that we discussed in the last 3-4 modules are long short strategies. That means you buy something, sell something. What do you do in price earnings announcement drift? You look at firms which have outperformed, go long on them. Look at firms which have underperformed, go short on them. That's a long short, right? Similarly, what you do in accrual strategy, firms with high accruals, you short them. Firms with low accruals, you go long on them. So most of the strategies, in fact almost all the strategies that we discussed are long short strategies. Of course, you can just trade with one leg of it, but the academic papers actually test the strategies using a long short approach. Now in a long short approach, actually theoretically what you have invested is zero. Just think about it. You sold a stock for 100, bought something else for another 100, and what you invested is zero or very close to zero, subject to rounding. Now how do you measure performance here? Now as we discussed in one of the modules, that for these kind of contracts where you are trading going short or going long, you will have to invest something known as margin. So that margin that you have to invest with your broker, that can become a base. So you can calculate return based on the margin, but you have to be really careful here. Assume the margin required in your market is like 15%. So you go long on a stock, go short on a stock. Now you have 30%, you invested just 15% of the total investment made. Now if you make 5% on the gross value of the stock, Even if you make just 5%, say your long has gone up 2%, your short fell 3%, so you make 5%. Now on the gross contract value it is 5%. Since you have invested just 15% in margin, your actual return will turn out to be several times more on the margin invested. It will not be 5%, 6 times more than 5%. Similarly, when you lose, if you lose 5%, that will also be several times. So this is something that when you measure based on margin, you should tell your investors that the fluctuations are going to be huge. So the ideal benchmark for a long short strategy is on the margin that you invest, because this margin, if in your country, if margin can be invested in say safe government bonds, the risk free rate that you make is the benchmark. You should make at least the risk free rate. Your market index is not the benchmark. So it's not right to compare a long short strategy with the market index. In fact, you will be tempted to do this on several occasions. Imagine you started a long short strategy and the market collapsed. Now because you have longs as well as shorts, you may still be positive, or you will definitely not fall as much as the market, because your shorts will make money when the market falls, right? Suppose during 2008, beginning of 2008, you had started middle of 2008 when the collapse happened, you started this strategy, long short strategy. Now what will happen is the market may fall 50%, because your shorts, your fund will not fall as much. Now at this time you will be tempted to claim that you have outperformed the index, whatever broad index, by a massive margin, which is true but not the entire story, because the index is long only. Index is not long short. It's only your trading strategy is long short. So you are comparing a long short strategy with the index. Now what's wrong with this? The problem is when the market rebounds 50%, maybe next year, you will not be able to keep pace with the market. You may be down, because why? When the market rebounds, in fact we have done this momentum crashes, if you remember. Momentum crashes paper exactly says this. When the market recovers, the losers come back viciously. They outperform winners significantly. So if you are short on, let's say you are doing a momentum strategy, long short, you are long on past winners, short on losers. Now losers can double, triple, go 4 times because of the optionality. You can go back to that class where we talk about momentum crashes, or you can read Daniel Kent's paper as well. So if these stocks come up when the market recovers, then the benchmark may be giving 50%, and you may be at 5%, minus 5%, minus 10% also. You will be cutting a sorry figure at that time. So it's very important not to compare a long short strategy with the index. So if you are doing a long short strategy, your ideal benchmark is margin and risk free return on the margin. Anything above risk free return on the margin, if you make, that is a positive. It's not the market index. You should keep this in mind. So to summarize, if you are only doing long only, then figure out an appropriate index which comprises of the kind of stocks that you will invest in the strategy, and choose that index as the benchmark. If you are going long short, then the best way that I can think of is margin, risk free rate on the margin. Just choose risk free rate on the margin, and anything more than risk free rate you can claim as outperformance.
Learning outcomes. After watching this video, you will be able to understand the importance of reporting and compliance.
So after benchmarking, now the issue is about reporting. It's absolutely critical that you report regularly to your investors what your performance is, and not only in good times, even in bad times, and explain very clearly the reasons why there has been a positive as well as negative performance. Now, a related matter about which I am not going to spend a lot of time, but it's a very, very critical. I'm not saying it's not important, but it's outside the scope of these classes, is compliance. Every country will have lots and lots of rules and regulations regarding investment, especially when you're dealing with others' money. This is because there have been a lot of frauds, lot of fraudulent schemes, so-called Ponzi schemes, where people take somebody's money and claim high returns, and then they pay back. When an investor comes, they take a second investor's money and pay back that investor, and they keep this going as long as it works. And when a lot of investors come and ask for money, these Ponzi funds run out of cash. This is something which has been seen everywhere, almost everywhere such schemes have arisen, and that's why regulations around this are very tight in every country. So it's important that you figure out what the laws governing these regulations are. Of course, I'm not suggesting that you sit and read the laws and figure out, which may not be possible. That's not your core competency. You have to go to the right set of consultants, lawyers, who can help you in this matter. Compliance is absolutely critical. So it may so happen that one small mistake in compliance may bring down your very, very successful strategy or business. So this is a hindrance. If you are a very small investor, if you do not have too much funds, compliance can be costly. Unfortunately, this is an hindrance, but there is no way around this. One has to fulfill the regulations, laws of the land wherever you are in. So that's why I suggest start with your own money of your family and friends. The rules and regulations governing these will be usually liberal, and once you establish yourself, once you have enough funds, enough people investing in your funds, then you can think of raising money from the public and consult appropriate consultants, lawyers, whoever is competent, who know about the laws and regulations of your land, of the country where you are in, before starting a venture in the field of algorithmic trading. And the rules will be not only about, rules can be on taxes, rules can be on registration of the business, even exchanges may have rules, reporting requirements, audit requirements, and so on and so forth. In fact, compliance, in a way, it's expensive, but it's also a signal. If you are compliant, let's say audited number, you can use that number to raise more money. So there is a positive side to compliance as well. It's not just you need not consider it as simply a cost. So, but it's absolutely critical that you follow all the rules and regulations applicable to investments.
Learning outcomes. After watching this video, you will be able to understand how derivative financial instruments work.
Hi, in this module, I will talk about some tips about backtesting, and also I'll talk about the kind of financial instruments that one can use for these strategies. I'll talk about this financial instruments part first. Remember, in all these papers that you studied, this is in the US setting. Most of them use US as the economic setting, and as you know, the markets in the US are well developed. You have all kinds of financial instruments, and more importantly, you are allowed to short in the spot market in the US. Of course, there were restrictions imposed from time to time, but by and large, you are allowed to short, and that market works well. But in many countries, the shorting is not allowed. You are not allowed to short in the spot market. So what do you do in that case? The answer is you can use derivative instruments. So futures and options. I've covered a bit in one of the previous modules. Again, we have a specialization on investment management. There we go in detail about derivatives. What are these instruments? So you can use derivatives, and in derivative instruments you can always short. Futures you can always short, or you can buy a put option. So that is allowed. But when you use derivative instruments, one has to be really careful, because what you do in derivative instruments is that you trade on margin. Let me give you an example. Let's say you are taking a position on some 400,000 worth a particular stock. Remember, derivative instruments, you cannot buy one or two stocks. There is always a minimum lot size. You have to buy a lot, and that lot will have a value. So lot will be number of units, 100 units of a stock, 50 units of a stock, it could be 500 units of a stock, so on and so forth. Let's say a minimum value of a lot of stock A is 400,000 in whichever currency it is. Now in futures, you do not have to pay 400,000 at the beginning itself. All that you need to do is to deposit a margin. I told you about this when I was talking about how do you decide a benchmark for future. So you need to deposit a margin. So you need to be, so that margin will be around 15%. Sometimes it can go up to 20% also. Usually in most countries it's around 10 to 15%. Technically it's based on something known as value at risk. Let's not get into that right now. But imagine it's like 15% of 400,000. That comes to what? 60,000. Now on the positive side, if the market goes up, if the stock goes up, let's say by 5%, say from 400 it becomes 420, you will make like 30% return, more than 30%, 33% return. That's huge. But on the negative also it works the same way. If the stock, let's say, falls by 10%, from 400 to 10% is 40,000, you have put in, let's say, so we assume 15%, 60,000, you lose 2/3 of your money. So one has to be really careful when dealing in derivative instruments. So just because the market gives you leverage, you should be careful. So if you have, say, 400,000 rupees with you, or dollars, rupees, whatever. So what I suggest is that even though the margin required is 60,000, 80,000 or 100,000, whatever, you keep the remaining amount in risk-free instruments or government securities. Do not over leverage. Do not think that the 60,000 is your principal. So whenever you are dealing in derivatives, my suggestion is that keep the margin plus remaining part of the gross contract value in risk-free kind of instruments. Then what happens? Now let's go back to the same example. Let's say 400,000 is the contract value and the margin required is 60,000, right? Now if the stock goes up by 10% and you have 400,000, you have two choices. One, just to make life simple, let's assume that margin required is 40,000, 10%. That makes calculation simple, that's all. So let me repeat. We are talking about a case where a gross contract value is 400,000 and the margin required is 40,000. Now if the stock goes up by 10%, right? So then and let's think about two scenarios. One is someone who's taken maximum leverage. The other is a case where someone has taken no leverage. The person who has taken maximum leverage will be buying how many contracts? Think about it. You have 400,000 with you and minimum margin required is 40,000. So you will be buying 10 contracts. That means you will be taking exposure worth 4 million. Yes, that's correct. So you will be taking exposure worth 4 million of that currency. Now if the stock goes up by 10%, so from 400,000, the contract value, if it becomes 440, because you now have 10 times leverage, instead of making 40,000, you will make 400,000. Very nice, huge, right? So that's on the positive side. Our defensive person, let's say this is an aggressive strategy. A defensive person, what will the defensive person do? Will put 40,000 in the stock as margin and put another 360,000 in risk-free securities. Just for the sake of example, assume risk-free security gives nothing. In developed countries anyway these days, risk-free securities do not yield much. In emerging markets they do. For example, in India, where we are located, risk-free rate is even today 6.5%. Let's assume 0% for argument's sake. So on 40,000, you make another 40,000 because the stock has gone up by 40,000. But remaining 360,000 makes nothing. So your total gain is 40,000. Actually will remain 10%. Whereas in the aggressive case, your gain is 100%. Why? Because you have taken 10 contracts, the stock went up by 10%, but your investment went up by 100%. All good. In a positive state of the world, it's all great. Now imagine the other way around. What if the stock falls by 10%? Now again same situation, you have 400,000 with you, gross contract value is 400,000 and the margin required is 40,000. Now the stock tanks by 10%. The aggressive strategy, the aggressive guy would lose how much? Yes, he will lose entire 400,000 because for each contract he will lose 40,000. Are you getting it? What has the aggressive person done? He is invested the 400,000 with him in 10 lots by depositing entire 400,000 as margin. That's what the aggressive person has done, right? Now if the stock falls by 10%, that means your gross contract value falls from 400,000 to 360,000. On each of those 10 contracts, this person loses 40,000. So effectively, you are left with nothing. Now come to the defensive guy. If the stock falls by 10%, what will the defensive person lose? 40,000. What happens to remaining 360,000? Where is it invested? Risk-free asset. It will remain as it is. So the upside is also limited if you follow the strategy, that defensive strategy, but downside is also limited. Now think of a case. What if the stock goes up by 15%? The aggressive guy will earn 150%. Defensive guy will make only 15%. But what if the stock goes down by 15%? Then the aggressive person will lose how much? 600,000. Yes, margin, it's not that your margin is gone and then you are free of responsibility. No. You are liable to pay the full losses on futures. So it is not limited up to your margin. In case value at risk, all these calculations are based on normal circumstances. But in case if the loss is more than the total margin that you deposited, you will have to make good that loss. That means if the stock falls 15% and you have 10 lots, on each lot you lose 60,000. So total your loss becomes 600,000. So not only you lose all that you have, 400,000, you will have to pay 200,000 from your pocket. Whereas in the defensive case, you lose your 40,000, pay another 20,000, 340,000 is safe. So futures is a double-edged sword that way. It works both ways. When things are good, it will help you. When things are bad, it can harm you. So my suggestion is, when you use these strategies, if you are forced to use derivative instruments, futures or options or any of these instruments, do not use over leverage using these strategies. So my suggestion is, keep the rest of the money in a risk-free investment and then trade.
Learning outcomes. After watching this video, you will be able to understand the need for back testing.
Hi, now let's talk about the most important aspect of this trading strategies, that is back testing. All that you can do with these ideas right now is back testing. You can't do, we don't have future prices. We do not know where the market is headed. So all that we can do is back testing. So I'm going to talk about ways in which you do a rigorous back testing. What are the things that you have to keep in mind? In fact, the results presented in the paper are nothing but result of you can think of a back testing exercise, because author has an idea and picks up data and sees whether it has worked over a period of time. Of course, they divide the sample into two parts, they figure out the strategy using one sample, test it on the other sample, they do all that, but all that goes on is back testing. Now given that the authors have already back tested, why do you have to do once more? There are two reasons. One, you may not be trading in the United States, so these are all strategies that have worked in the US. And the second most important reason is the purpose, that your purpose and those authors' purpose is different. You want to actually make money, trade and make money, not to show that there is a particular kind of market failure or a particular type of asset pricing formula doesn't work. That's not your purpose. So you want to actually see whether it makes money. And more importantly, there is a third reason. There is a famous saying, which is attributed to Keynes: market may remain irrational longer than you may remain solvent. Now, on an average, something may work. It's possible that over a 5-year period, a particular strategy has given you some fabulous returns. But if there are periods in between, if there are times in between where there have been massive shocks, the trader might get wiped out. Especially those who are trading in using margin. I already told you in the previous module that 15% shock can wipe out a margin trader. The next day stock may think about a trader who takes a position using margin and the stock price is 100 and he invests 10 as margin and the stock crashes by 15%. He loses all his margin, puts another 5 from his pocket, stock goes another 10%, he has to put another 10 from his pocket and he will give up. And soon after he gives up, stock may recover 50%, but he will not be there to see that recovery. That's the whole point of this Keynes statement. Market may remain irrational longer than you may remain solvent. All these formulae may be right, that stock price will come up or reach a particular level, but what about the fluctuations in between? So when you do a back test, you have to remember that as well. What type of shocks your strategy will be subject to? How deep will be the shock? Or how deep has been the shock? Nobody knows how deep will be the shock, but how deep has been a previous shock? And what kind of capital you are likely to have when faced with that kind of shock? Will you be able to survive? Suppose you face the same shock that happened few years back, will you be able to survive? That's another question. A fourth reason why you need to worry about these shocks, especially when you are dealing with others' money. You may be super confident about your abilities. You may think that you will do well over a long period of time, but investors who have given money to you may become impatient, say in few months. 3 months of continuous underperformance may be enough for number of investors to pull the plug. So they may ask for refund of their money, return of their investment, not return on. They may ask you to give back their money exactly at the wrong time. You may know that after 3 months of underperformance, this strategy is likely to outperform in the next 3 months, but the investors may not believe. That is another reason why you have to worry about the shocks and how much downside a strategy has. So a thorough back testing, a scientific way of back testing is important to do, important before you embark on a trading strategy.
Learning outcomes. After watching this video, you will be able to understand how to perform a back test.
Now, how do we do a back test? First thing you have to figure out when you read the paper, I have told you right at the beginning itself that the two most important sections in a paper that's useful for someone who wants to trade based on the idea of that paper are: one is the section that describes the algorithm. The second is a section that describes the data. Now, if you want to trade in the US, you can just go to that paper, figure out the sources of data, and you can download stock prices or whatever information is required. But you may be trading in other countries. So then the first challenge is, where do you get that data from? So for example, let's say your momentum strategy. All that is required for momentum strategy is stock prices. You need to have closing stock prices. So you have to figure out the source that gives you closing stock prices in your respective market. Whereas let's say you are doing price earnings announcement drift. In that case, you need detailed accounting statements, not just stock prices. You need the cash component, accruals, and to calculate accruals. Go back to the module I showed a couple of modules back, that the way you calculate accruals, you need to know receivables, payables, cash in hand, investments, a lot of other things that are required. So you have to understand, you should figure out what source gives you all this information. One way is to go get into the website of each and every company and download this. That's going to be time consuming. I'm sure in most of the countries there will be databases that give you this kind of information. So if it is US, you can just pick from the paper. If it's your country, you have to figure out these sources. That's very, very important. So step number 1 is to go to the paper, read what data the paper uses, and step number 2, find out the source, and then obviously download. Once you have the data, a very important point when you do a back test is you should do the test thinking as if you are sitting at that time. Now what do I mean by that? Let me explain. Now imagine you are trying to test whether post earnings announcement drift works, if that's what your purpose, right? Now what do? You have downloaded stock prices, you have downloaded earnings forecasts, you have downloaded the actual numbers, you have calculated standardized unexpected earnings and all that, suppose. Now you want to see whether this worked in the year 2006, let's say, right? Now let's say your financial year starts from January 1st. Now my question is, you already arrived at winners and losers let's assume you have arrived at the stocks that you have to buy and the stocks you have to sell, right? So is the setting clear? You are trying to see whether PED works, post earnings announcement drift works. You collected all the data and you have arrived at stocks that you have to buy and the stocks that you have to sell, right? And you are testing whether this strategy has worked in the year 2005. That's the scenario. Now you take this date January 1st. Can you do this trade on January 1st? Can you test whether, let's say your holding period is 1 year. Can you test whether, can you take the price of winners on January 1st? What do you mean by, see, when you back test, going long means what? You take the price on day 1, take the price on last day and see what is the return, right? So if day 1 is 100, last day is 120, your return is 20%. That is for longs. For shorts, day 1 is 100, last day is 120, your return is minus 20%. That's correct. Because you are short, you have sold it at 100, you are buying at 20. So you have lost 20 rupees or $20, whatever, right? So my question is, for price earnings announcement drift, can you take January 1st as day 1? Think about it. The answer is a big no. Why? Because financial statements will not be ready on January 1st. Even if, usually in any year, so if December 31st is the year ending, no company will publicly declare results on January 1st. It takes time. The accounts have to be finalized, the audit committee has to approve, the board finally has to approve, auditors in between audit process is there, and finally this has to be announced. It usually takes anywhere between say 20 to 40, sometimes 60 days. So a back test starting from January 1st is not a realistic back test, because you are not doing the test thinking as if you are going to trade. This will become just an exercise to find out the price movement from January to December. So if you were in 2005, you could not have traded PED on January 1st. So whenever you do a back test, you should ask yourself, you should you should think that you are in that time zone and ask yourself whether any data that I am using, does it have a look ahead bias. Look ahead bias is very important, because now you know that sitting today, you know the January 1st price, but on January 1st all the accounting numbers, but on January 1st you didn't know January 1st the accounting numbers relevant for January 1st, the previous December 31st accounting number. So give a gap of 2 months, then do the calculations or figure out when they announce the results and start trading, start your back test from that day. I hope the point is clear. This is very, very important, otherwise your back test may give you misleading results. All that I am trying to say, let me summarize this. All that I am trying to say is that you should not induce look ahead bias in your test. So any test you do using past data, the test should be designed in such a manner that whatever data was available at the beginning of the period, you should use only that. You cannot use the data which came later. So this is very, very important when you do a back test. Second, another very important point is that whenever we do a back test, we have this problem of survival bias. You cannot just pick up companies that exist today and go back like 10 years, calculate their scores, rank them and trade. That's not correct. Think why. 10 years back, you didn't know that these are the companies that will exist 10 years for. There were many, in fact, every 20-30 years, if you look at composition of many of the indices, you will be surprised to see that most of the companies or many famous companies at one point of time will not be a part of the index after say 20 years. This has been the history. So you cannot use today's strongest companies and go back 10 years and do the back test and say some strategy works. No. At that time you should take what the companies, suppose if your strategy is to take top 100 companies, let's say you will trade only on top 100 companies. Taking today's top 100 companies is a strict no. You should take top 100 companies of that year, a year before that. Again, not that year after, year before that. So this will take care of survival bias. That will give you a realistic picture, because among today's 100 companies, top 100 companies, 10 years down the line, 50 of them may not survive. So think about it, right? The companies that have survived today, the top 100 companies that they have survived today are the ones which did phenomenally well maybe over the last 10 years. But you could not have selected them 10 years before. Now for back testing, if you use these companies, you are implicitly assuming 10 years back, you knew that these are the 100 companies that will grow in the next 10 years. That's a very, very wrong assumption. See, always stake the odds against you when you are doing a back test. Nothing you will gain by getting fabulous back testing results. You will have to get results in real trading, not in back testing. So it always helps to put the stakes against us, not in favor of us. So going back to this example, look at 100 companies at that time, and among those 100, some have survived, some have not survived. You might have longed those who have not survived, or you might have short those who have not survived, then you would have made money, and then see what has happened now. So this is going to happen with today's 100 companies also. So when you are going to trade with today's 100 companies, some of them will survive, some of them will not survive. So that's another thing about avoiding survival bias. Third important thing that you have to remember when you do back testing is that the prices that you will get, most of your trading strategies will have prices, right? These prices that you will get will be closing prices. Now the problem with closing price is, in many countries, closing price is the average of last 30 minutes, 45 minutes, 1 hour or whatever. Now if that is how your closing price is calculated, then you will not be able to trade using this closing price. So you have to figure out the last traded price. The last traded price is the price at which one could have traded. And you have to remember, there are stocks which are, suppose it's not traded in the last 3 hours, 4 hours or 2 days, you should not consider such stocks, because their price is, think about it, right? So you take a stock which was not traded for 3 days in a row, and you take the price for a year, in any year, you take 3 days, a stale price. Now in these 3 days, assume the market has fallen by 10% for some big event has happened, and this is a high beta stock, this would have fallen by 25%. Now if you use this for back testing, you will be using a price 3 days back which will be like 30% more than what it should have been. And if your strategy says short this stock, and by chance the next day if the stock trades, it will open like 30% down, and your strategy will say you have made 30% money. Let me give you an example. I think this point is not clear. Let's say a particular stock is trading at 10, and on day 0, let's say day 1, 2, 3 the stock has not traded and the market has crashed during this time. Now you are doing a back test sitting on day 3, and when you do this back test, suppose you take the price as 10, which is day 0 price, and assume that, and your formula says go short this stock on day 3, right? Now you will think in your back test that you are shorted at 10. Remember, this 10 is 3 days back. This stock was never available at 10 on day 3 because it was never traded. Now on day 4, the stock may open at 7 after a gap of 4 days. But what your back test will assume, you are shorted at 10 and then the next day it's 7, you made 30% return, which is totally wrong. And similarly, it may go on the other side also. So you should remember, you should first see whether the stock was traded as close to closing as possible, and is it a liquid stocks. Stocks that do not get traded for days together, it is better to avoid them. Leave them out of the sample. Now let's enter the last phase of the course. You learned various strategies, some of them based on accounting, some of them based on stock prices. For example, earnings announcement drift, you learned about accruals, you learned about momentum, you learned about momentum crashes. In the process, you also picked up knowledge about some financial instruments, options, futures, long, short, all that. And we also talked about back testing, we also talked about compliance and other related concepts. Now, what do we do from here on? Now that you know about these strategies, what do you do from here on? Are you ready to start trading tomorrow morning? The answer is maybe no, or a guarded yes. I'll tell you why. Because as I warned you before in one of the modules while talking about a particular strategy, that actual trading and back testing are very different. So in actual trading, you have a very big thing to take care of, that's your own emotions, which is not there in back testing. When you back test, you get some fabulous return or you lose a lot of money, nothing much happens. Of course, you may feel happy, but when it happens in reality, it's a different ball game altogether. So it's important that you get some practice, some kind of simulated environment before you actually jump into trading. So what I suggest is that you do your back testing, arrive at long shots, but start with mock trading. Don't put in real money as yet. So start with mock trading. So there will be a lot of websites which will have this kind of dummy portfolios. When I say mock trading, what I mean is the prices are real, stocks are real, but you're not putting in actual money. It's like imaginary trades. So these websites allow you to have your own portfolios. You can track performance. You can see what has happened to each stock on a daily basis, weekly basis, monthly basis as the strategy requires, and do this for say couple of years. This is absolutely important. That will tell you how disciplined you are, and try to be as realistic as possible. Don't, lot of people cheat even in back testing. Don't do that, because ultimately the markets that will not give you such opportunities. Keep the numbers as correct as possible and see what is happening to these strategies. So do this for a couple of years, and if you find that what you find with real prices, what you find with the actual trading is close to your back testing results, then you have reason to be more confident. As I told you, there are a number of reasons why back testing numbers and actual trading numbers may be different. Of course, one is cost. You have taxes, you have transaction costs, that's fine. There is also the prices used in back testing could be stale. And finally, there is something called impact cost. That's something that we have not spoken about before. It's important that you know your trading itself can influence prices. Imagine you are trading in a illiquid stock which is not traded for 3 days, and you go short. You need to have somebody on the other side, right? So somebody who is willing to buy, and that buyer, if he comes to know that there is somebody desperate to sell, may reduce the price at which he is willing to buy. So the profit that you hope to make by going short at a particular price, you may not be able to sell that price and make profits in reality. Whereas you can do this with a back test, because you take the last available price and then see what happens to the price 3 days. You don't take into account the fact that you trade and bring down the price. You could bring down a short, and similarly when you buy, you could trade and bring up the price. So if that happens, that itself may eat away a decent portion of the returns that come in back testing. This is very important to understand. Please bear this in mind. You should not think that back testing gave you like 50% return, but in reality you are making only 20%. Which there is a possibility that you are dealing with illiquid stocks. If you are dealing in liquid stocks, which are large stocks, if your size is small, then the impact cost is unlikely to be high. Let's say you are dealing with Microsoft stock, and you are talking about buying or selling few hundred shares. That won't make much of a difference. Your actual results will be close to what you get in a back testing exercise. Second thing is, you need to stick to the rule. As I've told you before, it's any change that you do should be to the rule itself, not in the implementation. Once you decide a particular rule, this is a strategy, these are longs, these are shorts, you will hold for whatever number of days, you should hold for that long. If let's say the stock goes up by, your portfolio suddenly up by 20%, you decide to liquidate because you have, this is called disposition effect, by the way. It's a well-known effect where people sell their winners too early and hold on to their losers forever. Then you may not realize the kind of return that you get in an exercise of back testing. And finally, once you're done all this, I recommend that you start with a very small amount of your own or friends and family. Don't straight away start with money from outside, because remember I warned you a little bit in a previous module that what happens with outside investors is that if you have a couple of months of losses, they may pull the plug at the wrong time. Just before your portfolio is about to recover, these people may withdraw their money and you may be in trouble. So that is why don't ask for funds from outside investors as yet. Build your own portfolio, take money from friends and family to the extent possible, run your fund for few years, build a track record, and then go for a fund with public money. And obviously you have to fulfill all your commitments, legal and all other compliance requirements. So I wish you all the best. We will soon come out with another module, hopefully on text mining. Till then, happy trading. Wish you all the success in your trading. Thank you.